Very warm good evening to one and all present in this first day of our 3-day series of WEBINT on Ind-AS. Hope with the blessing of Lord Jagannath, you all are healthy and well. Respected Chief Guest, CMA H. Padmanabhan Sir, and special guest CMA Niranjan Mishra Sir. Today's young and dynamic resource person, CMA Ramshankar Mishra Ji, who is the family member of our Bhubaneswar chapter and alumni. Past chairman of the chapter, past chairman of EIRC, regional council members of EIRC, esteemed member and stakeholders. Chairman PD committee of the chapter, CMA Shaktidhar Singh Sir, who will join soon considering the last moment unavoidable circumstances. Secretary of the chapter, CMA Srijanarayan Tripathi Sir, and all my professional committee. I, CMA Himoj Mishra, chairman of the chapter, warmly welcome you all to today's inaugural of 3 days series of WEBINT on Ind-AS. Today, topic has been chosen considering the present requirement, specifically when most of the corporate and private sectors are going to finalize their accounts. Hope inputs from the deliberation of entire day's program may be helpful to all of us. Today's discussion shall be held on Ind-AS 8 accounting policy, change in accounting estimates and errors, and Ind-AS 36 impairment of assets. The next 2 days schedules, in 24th, we have Ind-AS 2, 16 and 38. Our resource person will be CMA BK Das Sir, Group General Manager Finance, Nalco Limited. In 25th, Ind-AS 24 and 37. Our resource person will be CMA Gopal Krishna Raju Sir from Chennai. Before introducing our today's resource person and guest, I would like to request our officials to play the Institute anthem to inaugurate the 3 days series of WEBINT in virtual mode by a token of respect to our Nobel Institute. Now it's time to welcome and introduce today's guest and resource person. CMA H. Padmanabhan Sir, Papan Bhai, is the council member of ICAI. He is currently the chairman, CAT, AAT Board, Public Relation and International Affairs Committee of ICAI. Thank you, sir, for acceptance of our invitation and join with us. Thank you, sir. CMA Niranjan Mishra Sir, Council Member of ICAI. At present, he is the Chairman of Committee on Cost and Management for Public and Government Services, ICAI. Thank you, sir, for joining us.
Thank you.
Next, CMA Ramshankar Mishra is an associate member of the Institute of Cost Accountant of India and one of the member alumni of Bhubaneswar chapter. He has more than 12 years of industry experience at TS Alliance Limited in the capacity of trainee finance, manager finance, and now senior manager finance. He joined as Mangalore Refinery and Petrochemicals Limited as executive finance in the year 2011, and at present he is working there in the portfolio of manager finance. His current work assignment at MRPL are analysis of Ind-AS, finalization of quarterly and annual accounts, along with compliance of all listing regulation as per SEBI 2015. Thank you, sir, for joining us. Without taking much of your precious time, now I request CMA Niranjan Mishra, sir, kindly address.
Good evening, my respected council colleagues, CMA Patwanavan, sir, Papan Bhai Sobka. Pan India is known as the Papan Bhai. So, accordingly, our chairman is privileged to name Papan sir, the Papan Bhai. So, my council colleagues and a very popular known face. And I am very much thankful to Papan sir because he has started this initiative WEBINT on Ind-AS, series of WEBINT on Ind-AS 1 year back, and still is continuing. And our eminent resource person, Mr. Gopal Krishna Raju, also joined hands to support our Padmanavan sir's initiative. And he is also one of the speaker day after tomorrow in the evening in this series of 3 days. So my respected resource persons, Mr. Ramaswamy Mishra, he is very close to me, and he is like our family member of Homes Chapter. And our most dynamic chairman, Himoti Mishraji, our Sujana Tripathi, secretary sir, the chairman of other chapters, members, and I expect some students, those that were recently qualified and joined our pre-placement orientation. They have also joined this India series because I advise them to join. And it is very memorable event for us because last year also in the same time, maybe 1 month gap or 1 month advance or back, we have started this India series for 3 days, and wherein Mr. Ramaswamy Mishra was also the one of the speaker, Mr. Vikedas was there, and we have taken Mrityunjay Chari, the one of the speakers. So 3 speakers were there for 3 days. Here we have taken the expertise of Mr. Gopal Krishna Raju. He is the most dynamic speaker on the Ind-AS and most wanted speaker on the Ind-AS, and he will speak on day after tomorrow. So this series is designed by the chapter, and obviously we have discussed all the regional council members, Bibin Naik sir, Uttam Naik sir, me, and chairman and PD chairman, and all management members decided to hold this series because now all the entities are at the verge of the finalization of the accounts. And before keeping the subjects, I have discussed with our honorable resource persons. I asked them, so there are a lot of standards, but what are pertinent to the finalization of accounts, and where the company will get benefits, and our people and the members, those are working in the various portfolio of finance departments in different entities, how they will get benefited out of the series, and what are the pertinent and most vital Ind-AS. So accordingly, with their support, with their advice, we have kept 7 Ind-AS. Today we are discussing on AS-36 and AS-8, and this was the best subject of Ramaswamy Mishraji. And Vikedas sir, he is very expert in plant, property, equipment, intangible assets, and inventory. Last year also is spoken, and it was one excellent program last year. So without wasting much of time, so I request the chairman to invite resource person to deliver on the topic, because he has chosen 2 topics, two Ind-AS, and I think it will be difficult for him to cover within 1.5 hours. So he at liberty to continue for more than 1.5 hours. So I again thank you very much, and I am again thanking all the participants, those are available here, and wish this program a grand success. Jai Jagannath. Namaskar.
Thank you, sir. Now I like to request our chief guest, CMA H. Padmanabhan sir. Please address.
Thank you so much, Himoj Bhai, our Honorable Chairman of Bhubaneswar Chapter of Cost Accountants of India, and our Secretary, Treasurer, Vice Chairman Santanu Sir, Tripathi Sir, everybody, Shaktidhar Singh Sir, who will be joining. Shaktidhar hai, wo Shaktiman hai, hamare liye. So, my dearest, as Niranjan Bhai told, Ram Shankar Mishra Bhai, who always attends all the institute programs, and because he attending lot of programs, we ask many questions. So other participants also benefit because the resource person will be trying to answer with examples. So thank you, Ram Shankar Mishra Bhai, for active participation in all the institute activities. And today, you being the speaker, I am very, very glad that my Chota Bhai is now today the speaker, taking the lead of the 3-day WEBINT series, that too on Ind-AS. And many, many thanks, Niranjan Bhai. In fact, I remember Niranjan Bhai as one of the dynamic person with the team of Bhubaneswar in the hand, right from 2015. Whichever committee he is handling, he will ensure that one national level prominent program is being conducted in Bhubaneswar. That way, Bhubaneswar has become the biggest hit. And we have seen many programs, including a program for the children, including program taking care of the health, even some morning this thing and this thing. I have seen MLAs, MPs and ministers coming and inaugurating. I was part of one of the event where that this thing also was conducted. Other than the technical and other this thing, health related program also during the COVID season. Despite Niranjan Bhai and team, some of them falling prey to that COVID was affected, but still the Bhubaneswar chapter under the wonderful leadership of each and every one of you. I treat all the people in the managing committee and Niranjan Bhai, SP Padi sir, another Chota Bhai, younger one. You all are working as a team. That other chapters are envying and having some specific, some complex. अरे ये लोग कैसा करते हैं, हमें कोई ऐसा नहीं कर पाए हैं, पा रहे हैं करके. So we are now, so Bhubaneswar chapter has become a role model. And one more thing I liked this term, 2019-23, when Niranjan Bhai gave solid support, we started again the state level chapters meeting. Then I saw Bhubaneswar chapter taking the lead, taking all the Odisha chapters together and conducting lot of programs. So kindly don't stop. Now that the COVID is a little bit over, maybe in June again some relatives of COVID are going to come, people are telling. Otherwise, please conduct such physical programs also. And definitely across the globe, across the country, people will love to come to Bhubaneswar and take the blessings of Lord Jagannatha. And that is also one of the duty that we get the blessing. So I always thank Niranjan Bhai, and I thank Niranjan Bhai who was very specific that I have to attend this program and should be there. I, being one of the organizers of WEBINT series along with our council colleagues, I was wondering as to how I can be this thing. Normally we form the role of coordinator and other thing, but being a council member, having some responsibility assigned, I accepted Niranjan Bhai's direction, instruction, I should tell, because he is my elder brother, and more importantly, I like such personalities who perform, and he is a performer. That I have told vociferously in many occasions for some other reason or the other, and that is the fact. So thank you, Niranjan Bhai, and Himoj Bhai, hearty congratulations. Being the chairman, you are getting a wonderful opportunity to have great personalities as speakers from youngster like Ram Shankar Mishra ji, then BK Dash sir, then GKR Bhai, that team. And please understand, this should be a beginning. Like you have done in March, you find some reason to conduct 3 days WEBINT series in April, May, June. Sustainability should be there. You don't worry that Papan Bhai, you are conducting at the headquarters level. Why should we conduct? No. Certain programs, certain timings, certain members will be able to attend this thing. So there is nothing wrong in repetition. As Niranjan Bhai told, the youngsters also are, should be encouraged to attend. In fact, all the passed out children, because they might go for placement, they should know some questions might come this time in the interview. So Bhubaneswar chapter is doing an excellent service. And the next time, or from yesterday itself, Niranjan Bhai instructed me, I have disseminated to all the children also. And from tomorrow, I will ensure that the CAT students from the CAT directorate, this Bhubaneswar program, this thing with the link is sent to all the CAT passed out students, because they are junior level accounting people working in different areas at a lower level. So if they perform very well, their management will like them and they might get the promotion also. So thank you for the wonderful service and thank you for inviting me. Thank you, Himoj Bhai. Ramshankar Mishra Bhai, all the very best as a speaker. I would love to listen to you. And Niranjan Bhai, many thanks to Santanu sir, everybody.
Thank you,
Thank you.
Thank you, sir. Namaskar.
Namaskar.
Sir, namaskar.
Thank you.
Sir.
Thank you.
Over
Thank
to
you,
Himoj
sir.
Bhai.
Thank you. Thank you, sir, for your guidance and some suggestions. We must take care of this in future. Thank you, sir. Now it's time of our resource person. Now I request CMA Ramshankar Mishra ji kindly start the technical session.
Kindly unmute Ramshankar Mishra Bhai. You have to unmute your mic.
Yeah, I hope my voice is audible.
Yes, it's audible.
Yeah, so let me just share my PowerPoint. My presentation is visible?
Yes, it's visible.
Okay. Respected Chief Guest of today, CMA H. Padman sir, my respected Niranjan Mishra sir, Chairman of Bhubaneswar Chapter, Himoj Mishra, Surya Narayan Tripathi sir, and other members of the Bhubaneswar Chapter Committee and the students and members presented in today's webinar. So let us not waste the time and start venturing regarding your today two topics I have to cover, that is Ind-AS 8 and Ind-AS 36. So just a minute. Yeah. So basically today what we'll do, I will just do a review of Indian accounting standard and how it converts to IFRS. Just beginning I will tell, because your Indian accounting standards are either converged from the Indian accounting, international accounting standard or international financial reporting standard. So how they have converged and how this IAS and IFRS have been now transposed or converged in Indian accounting standard, that briefing I will just tell for the information of some of the students are here. That's why I thought to share this so that they can have a fair idea what is international accounting standard, what is IFRS, why Ind-AS is there, why AS was there, whether AS is now applicable or not. So just briefing, I will just tell this one, and after that I will jump the part one of my student session, that is Ind-AS 36. Ind-AS means Indian Accounting Standard 36, and it basically I'll brief discussion on impairment of assets. And my thrust area of today's evening is understanding of value use, which is a very complex thing in today's scenario. And as Niranjan sir told, this time Indian Accounting Standard presentations are basically taking into account the closing schedule of all the corporates, those who are dealing with Ind-AS. So wherever the Ind-AS are relevant and can help the users to understand the year-end closing by referring to the standards, that they only basically structured. And accordingly, this Ind-AS 36 is basically year-end activity. No doubt, some of the assets that we have to do in between the years also, but basically it requires the end of the financial year. Similarly, concept of accounting policies change in accounting policy and estimates and errors, that is also basically is a year-end activity, because year-end activity you have to go check your policy, because the accounting policy basically we see at the end of the year only. So this is also a year-end activity. So this part 2 I'll cover Ind-AS 8. So a brief introduction of Ind-AS and IFRS. What is Ind-AS? What is IFRS? Just I'll brief. Most of the students and members of our institute, they may be knowing the general accepted accounting principle that runs over 10 pillars of basic accounting assumptions or principles or concepts. So this gap is a very large connotation. It is not a small thing. Gap covers everything. You can take accounting standard, Indian accounting standard, ES gap, IFRS, whatever things are going on in accounting, all are under the purview of gap. And the gap's charm is that it holds so many components, around 10 components are there, which is the spirit of any accounting. Without this, no accounting can be possible. So this gap is required to be kept in mind at the time of doing any accounting activity in any organization by anybody. So the gap is the origin of everything. So how the gap has now been transposed to Ind-AS, AS, IFRS, all these things one by one I'll touch now. So basically the general accepted accounting principle gap is maybe of two types, national gap and can be international gap. International gap means those overseas companies, those standards they are following, that is basically international gap. And national gap means it is basically Desi standard, means like in India we have AS, so it is a national gap. And similarly international gap means AS followed by UK and several European countries, so that is international accounting standard. So now that is reincarnated, that AS is now reincarnated to Indian accounting standard, and IS, earlier what IS was there, that has now reincarnated as your IFRS. So basically it's a new version of accounting standards. New version is Ind-AS and IS new version is IFRS, and basically Indian accounting standard is in line with IFRS only. So actually if you go to the basic, the gap is a, as I told earlier, is the biggest terminology and which covers all the standards like AS, IS, Ind-AS, IFRS, everything. So now suppose one Indian company is there or Indian standard is there, and they want to do IFRS, and most of the members and students know why IFRS is required, because the international competition and the investment, a lot of reasons are there. So suppose you want to converge from the national standard to international standard, you have to go for IFRS. So there is two options for all the countries. Either you can adopt the IFRS or you may converge to IFRS. Like Bangladesh, that country, their accounting standard, they have totally copy pasted the IFRS. So basically we can say that they have adopted the IFRS. But as far as Indian scenario is concerned, here we have not copy pasted the 100% IFRS. We have taken certain standards and put in our existing standards, and we convert it to IFRS. So basically it is not a copy paste, rather it is a requirement based. So that's why we can say that Indian scenario, it is a converge, but some other countries like Bangladesh, it is adopted. So as I told, two options is the conversion or adoption. India has two options, but we have a converge to IFRS and converge its existing accounting standard with IFRS. To converge means to tend to meet at a point. The converged accounting standard is known as, in a certain connotation, is known as Ind-AS, that we are popularly tells us Indian accounting standard, or Ind-AS in short form. So this is the journey how we have done it from the international market to national market. This is the journey of IFRS to Ind-AS. And basically, if you see, around 41 to 42 standards are there in IFRS and IAS. I'm not going for this how IAS, IFRS, that will take some more time. But basically, earlier IAS and now IFRS, both standards are there, and these standards are converged into Indian accounting standard. Around 42 standards are there. Similarly, as I have highlighted here, you can see that IAS 8 accounting policy, change in accounting estimates and errors are there. That today we are going to do this one. And along with that, if you see IAS 36, impairment of assets, now that is Ind-AS 36, and earlier IAS was Ind-AS 8. So both are copied from international accounting standards, and it has converged to Indian accounting standards. And today our focus area is these two standards. So basically, if you see in Indian accounting standard, our Ministry of Corporate Affairs, they actually basically pronounces the Ind-AS. And as of now, as on today, around 39 Ind-AS have been pronounced by MCA, and all corporates, as per the requirement or the eligibility or compliance standard, they have to follow, all these companies have to follow that 39 standards. And here you can see the 39 standard list is there. And those companies who are required to be complied with Ind-AS, they have to follow all the standards mandatorily from the transition date. From the transition date, they have to follow. So now almost those companies have been following. So here, if you see these 39 standards, this Indian accounting standard Ind-AS, that is called accounting policies, change in accounting estimates and errors. This is one of the standard. Simultaneously, Ind-AS 36, that is impairment of assets. So these two standards today we are going to cover. So let us now start with this main standard, that is part 1 is my Ind-AS 36. This is my thrust area for the today's evening, and now I'll start for the impairment of assets. So before going to the standards, actually you need to know what is the component of the standard. As you know that some of the standards are 3 digits, some of the standards are 2 digits. And today's, fortunately, I have got the standard. Basically, they are of 2 digits because 8 and 36. So this Ind-AS 36, that is impairment of asset, it has total 138 paragraphs. It is a mammoth standard. It's a very big standard. And its practical difficulties, lot of difficulty and understanding issues are there in the standard. It is not so straightforward or very easy to apply all the directions of the standard. So this standard has basically 3 appendix. Appendix A, which talks about using present value technique, that today I will tell you how to do that present value technique. Appendix B, reference to matter contains in other accounting standard. If any reference is there to this standard with any other standard, that will also I will tell. Then Appendix C, impairment of testing of cash generative unit and goodwill and non-controlling interest. This component I am not going to cover because within this time all these things cannot be covered because it is a very big understanding is required for CGU, goodwill and NCA. These 3 things requires a lot of time. So today that I am not covering. And Appendix 1 comparison with IAS-6, as I have in my earlier slide, I have already told that this Ind-AS 6 has replicated from this IAS-36 only, because here already I have shown this IAS-36 has now been Ind-AS 36. So comparison of IAS-36 and with impairment of asset is one more requirement. And as far as Appendix 1 is not forming part of the standard. So now let us start with the objective of the standard. The objective of the standard is to prescribe the procedure that an entity applies to ensure that assets are carried no more than its recoverable amount. Just before starting this, I will just take one example to just make the audience understand what exactly this asset, what is this recoverable amount, what is impairment testing. So if I give one small example from the beginning, it will be for all of you to understand when I will use any paragraph in the standard. Let us take, if you go to the Schedule 3 compliant financial statement of any company that are listed and their annual report, if you go, the top of this list, you will get your asset and the bottom you will get liability. So basically, if you go to the balance sheet structure is non-current asset, current asset, then your other equity means equity and other equity net worth, then non-current liability and current liability. So basically asset part is the top part, and asset is basically of 2 types. One is financial asset, one is non-financial asset. So under financial asset, non-financial asset, both are covered under Ind-AS 36, and some of the financial assets are covered under Ind-AS 109 for their impairment testing. So let us take one example. One company has some property, plant and equipment. It is a non-financial asset. And what that company will do, that property, plant, equipment, either it will hold those property, plant and equipment, use in the operation and get some benefit out of that, or else it can use some time. After that, it can dispose that asset and generate some revenue from operation, and after disposal of the asset. 2 ways they can use the property, plant, equipment. Per se, as on 31st March 22, the WDB or written down value means your gross block less accumulated depreciation is equal to WDB. Suppose WDB of that asset is 100 rupees. So now you have to test at the end of the year whether the property, plant and equipment, what WDB of 100 rupees is there, whether it is fair or it is true or it is not. Then how you will determine? Either you have to go and you have to check, if I sell this asset today in the market with arm length, means with a valid transaction, then how much amount I'll fetch out of that selling of that property, plant and equipment. If it is more than 100 and your carrying amount is 100, carrying amount is nothing but your WDB, then your conservative accounting principle is there that whatever you are going to realize in your book, it is carried lower to that. So it is a conservative accounting. Under GAAP, I told 10 pillars are there. One of the pillar is conservatism in accounting. So though I am going to get 150 rupees out of that asset, but in my book, that carrying amount is 100 rupees. So I am doing a conservative accounting, so no need of any impairment. Or else, one more thing, if I am not going to sell that asset, I will use that asset. So by using that PPE or property, plant, equipment, in future, how much money I will generate, and that money's present value is how much. If it is more than 100 rupees, then there is no requirement of any impairment. But if that future cash generation's present value, if I discount that future cash generation to the present value, if it is less than 100 rupees, yes, definitely it attracts impairment. and that impairment has to be tested, and that differential amount, which is more than the carrying amount of the asset, is required to be provided in the book. So how to do all those valuation, how to provide impairment in books, what disclosure we have to make, all the things now one by one will capture in my subsequent slides. So an asset carried more than its recoverable amount. As I told, what is recoverable amount? Recoverable amount means your value in use or your fair value less cost of disposal. Means either I will sell that asset or use that asset. In that two things, which amount is more? Means suppose I will sell 150 rupees and by using the asset I will earn 180 rupees. Then out of this, which amount is higher? Means 180 rupees. That is need to be compared with the book value. And if that carrying amount is more than that recoverable amount, then that differential amount is required to be provided in the books as impairment loss for that asset because of conservative accounting. So if this is the case, the asset is described as impaired and the standard required the entity to recognize an impairment loss. If it is more than that, then you have to provide the differential amount. So the standard also specifies when an entity should reverse an impairment loss. Today, today you think that the asset when you are selling, you are earning only 150 rupees, whereas the carrying amount is 200 rupees. So what you are required to do, you have to provide a 50 rupees of impairment in the books of account. But tomorrow, suppose that assets realization value or recoverable value has gone up to 250 rupees. So what you have provided earlier, what 50 rupees you have provided in the books as impairment loss, you have to reverse it from your books of account, so that the real presentation of the asset will be done in the books of account. This is called reverse of impairment loss. So basically, as I told earlier, type of asset is basically two types. One is your financial asset and one is your non-financial asset. So already I have told that PP is your financial asset and PP is your non-financial asset. Your debtor trade receivable is your financial asset. Inventory is your asset that is neither financial nor non-financial depending on the situation. Your trade payable is a financial liability. So Schedule 3 basically and Ind-AS 1 speaks about what is financial and non-financial. So we'll see how financials and non-financials impairment is being done as per Ind-AS 36. So this graph, if somebody will understand, then impairment problem 90% is over. Basic understanding is over. So as I told earlier, carrying amount. What is carrying amount? Carrying amount is nothing but the WDB or the value in is the asset is carrying in the books of account. That is called carrying amount. What is recoverable amount? Recoverable amount is either fair value less cost of disposal, means I am selling the asset, how much I am getting, or value in use. In future, what revenue it will generate, its present value is called value in use. So this recoverable amount, if it is, if carrying amount is more than recoverable amount, then impairment loss will be attracted. So how to do the impairment loss? Carrying amount minus recoverable, because your carrying amount is on a higher side and your recoverable amount is on the lower side. So to bring it down to your recoverable amount, your carrying amount minus recoverable amount is equal to impairment loss that we have to provide in the books of account. So this is pretty clear. So now let us go to the scope of the standard. This standard does not apply to inventories. Asset arising from construction contract, deferred tax asset, asset arising from employee benefits. Yes. If you go to any Indian accounting standards, they are specifically talks about different things. Suppose Ind-AS 2 talks about inventories. Asset arising from construction contract, it talks about your Ind-AS 115. Deferred tax is your Ind-AS 12. Asset arising from employee benefit, Ind-AS 19. So wherever these things are being taken care by in other standards, this Ind-AS 36 is not applicable to that. Similarly,
Ramshankar sir, slide is not changing.
just a minute. Whether now changing?
No, it's on page 1.
Now it is changing?
No, it's on page number 1.
Just
क्लोज करते आते भी शेयर करो अभी आउटफ्लो करछन
whether now changing or it is not changing.
No, it is on page number 1.
Just a minute.
नेट तो ठीक है
Now also it is not changing.
No.
Can I leave once and join once again?
Yes, yes, yes.
Just a minute. Hopefully now it is visible.
Visible.
Now slides are going.
No, slides is not visible now. Before 2 minutes, before 1 minute, it was visible. Now visible. Now visible.
Now visible.
Okay. Yes.
Okay. Okay. Sorry for the disturbance. So I thought it is actually basically I covered this one, Indian Accounting Standard Part 1, Part 2. What I told IFRS and your Part 1, Part 2. Then my brief introduction was on the Ind-AS and IFRS. This gap 10 columns I have already explained. What are the fundamental assumptions of gap? Based on that, we are doing our accounting. Then I already informed that the general accepted accounting principle, the national gap, international gap, then how the AS to Ind-AS and IS to IFRS has been done. that I have already explained, but I think that time my slides were not visible. Then this standard also I have told how the IFRS have been adopted and how conversions have been made. Then the same thing I have told why India has converged to IFRS not adopted. Then I have told you what are the international accounting standards and IFRS standards available. Around 42 standards are there. In that, IS-8 is today's agenda. Similarly, AS-36 impairment of asset is today I am going to deliberate. And after that, I told how 39 Indian accounting standards have been pronounced by MCA. What are those standards? And how Ind-AS 8, that is accounting policy, change in accounting estimate and error, is working, and how it what requirements are there, that also I am going to present. Then I have my agenda is Ind-AS 36, that is impairment of asset. On that also I will deliberate today evening. So my first part was Ind-AS 36, that is impairment of asset, what, how and what makes the Ind-AS 36. So basically I told 138 paragraphs are there, appendix A, B, C are there. And what are the appendix ABC talks about? Appendix A is not part of this standard. Appendix 1 is not part of the standard. Then I already told what is asset, what is financial asset, what is non-financial asset, how carrying amount is there, what is recoverable amount is there, and how to compute that impairment, when you have to do, and how to do the reversal. Everything I have already informed. And further to that, I have already told that how impairment loss can be reversed also I have explained. Then financial, non-financial asset also I have explained in my earlier things. My deliberation I have already made for those things. Then in this graphical representation, I have told how carrying amount, if carrying amount is more than recoverable amount, then impairment loss attracts. And impairment loss is nothing but your carrying amount, that is your WDV in your books of account, minus the recoverable amount that you are going to get either as disposing the asset or through use of that asset. And that differential is called as impairment loss. And how to account for that I will cover in the subsequent slides. Then the scope of the standards also I have already explained, how inventory, asset arising from construction contract, deferred tax being taken care by in different standards, like inventories accounting is being taken care under Ind-AS 2, asset arising from construction contract is being taken care under Ind-AS 115, deferred tax is under Ind-AS 12. So all these standards, how to diminish that value of inventory, asset, deferred tax are being taken care there. So those things are not covered under Ind-AS 36. And the contains requirements of recognizing and measurement.
Ramshankar ji, are you in slide number 7?
Now it is moving or not?
Not, it is fixed at number 7.
But here I am, it is moving. Now not moving.
No.
But I have not done anything. It was going on. Suddenly, I think it is getting stopped. From my side, I have not done anything. Whether now it is changing?
No, not changing. There is an option in resume slideshow.
Pause share is there. Now also slides are not moving.
It's on 7 now.
Now slides are moving.
No, it's on 7.
From my side, I have not done anything. I am simply presenting. Now slides are moving.
No, now it's on 7.
Now also it is not moving.
No, now it's on 7.
Just 1 minute. Just 1 minute. Stop share. Again, I'll go. What about now?
Now it's now it's moving. Yes, moving.
Okay. So this identifying an asset may be impaired is visible from your side?
Yes.
Okay. So this scope I have already done. So now under this scope, the standard also applies to financial asset. Means like I told, the property, plant and equipment. Suppose one company has investment either in a subsidiary company, associate or joint venture. So what will be reflected in the financial statement of that holding company? It is investment. So investment basically is a financial asset. So financial assets are basically taken care by Ind-AS 109, but exclusively under Ind-AS 36, the impairment testing of the investment in subsidiary, associates and joint ventures are being taken care. But other financial assets are being taken care under Ind-AS 109. So these investments are under the purview of Ind-AS 36. So actually, basically under this Ind-AS 36, para 7 basically talks about the definitions. All the Indian accounting standards has its definition section, and this para 7 for Ind-AS 36 talks about the definitions. So here the important thing is carrying amount. As a while back I told that carrying amount is nothing but the asset recognized after deducting the accumulated depreciation. Means suppose today you have purchased one asset of 100 rupees, you have used it for 1 year, and that life of the asset is suppose 10 years. So every year in a straight line method, you have to charge depreciation for 10 rupees. So at the end of the first year, 100 rupees is the gross amount, less 10 rupees of the depreciation for that year. So 90 rupees is your WDV or written down value. That amount itself calls as carrying amount because it is carrying in the value in the books of accounts. A cash generating unit that very commonly known as CGU also among the accountants, and it is the smallest identifiable group of assets that generate cash. Either one plant in one asset in a plant can generate cash. It is practically very difficult. If you see in any manufacturing unit, one particular asset at its own cannot generate revenue. If it is generating, then that asset itself is a cash generating unit. And if it is not alone doing, and it has to work with other assets to generate revenue, then the combination of all assets altogether known as the CGU or cash generating unit. So it's the smallest identifiable group of assets that generates cash flow, cash inflows that are largely independent. Means it is not dependent with anybody else. Suppose that 10 assets among themselves working, they can generate revenue, then 10 assets are known as your cash generating unit. If individual asset can also generate revenue, then that individual asset also can as cash generating unit. So it depends regarding their independability. So that if they are independent, then that is called cash generating unit. Corporate assets are assets other than goodwill that contribute to the future cash flow of both the cash generating unit under review and other cash unit. Because corporate asset basically, if you see your corporate office, it is exclusively meant for all the operating locations. So in layman's concept, that corporate asset is your corporate office only. So when it can be used by multiple cash generating unit. Similarly, cost of disposal, as I told that your recoverability of the asset can be either use of the asset or disposal of the asset. But to dispose, you need to incur some expenditure so that you can sell it. So that incremental cost directly attributable to the disposal of the asset or cash generating unit, excluding finance cost and income tax, is not known as cost of disposal. That one graphical presentation I will give. Himoji, now my presentation is visible, na? Cost of disposal.
Yes.
Okay, thank you. Then depreciable amount is the cost of an asset or other amount substitute for cost of the financial statement less its residual value. What is depreciation? I think everybody knows. Depreciable amount is suppose 100 rupees asset, 10-year life. Every year 10 rupees we have to reduce from my asset value. That is called depreciation amount. Similarly, amortization, it is for intangible asset, because in Schedule 3 or Ind-AS, now depreciation and amortization is similar. What earlier we were saying, intangible amortization and tangible is depreciation. Then fair value, Ind-AS 113, which talks about fair value. Fair value is the price that would be received to sell an asset or paid to transfer a liability. Suppose I have one asset, I will sell you, but I don't know you because you are not my related party, or I have to do that transaction on arm's length. So suppose that asset, if I sell you, you pay me 100 rupees. That is called the fair value. If I'll pay some to my relative or any intention is there, they may give me lower to 100 rupees or higher to 100 rupees depending on the situation. So that is not the fair value. It should be between market participant at measurable as measurement date. Market participant means it is common for everybody. Like I have gone to the open market, I quoted my asset, and if somebody will come, that person is not known to me, then that is called as market participant, between market participant at a measurement date. So that is a orderly transaction, means there is no biased intention behind the sale of the asset. Then an impairment loss is the amount by which the carrying amount, just before I have already explained in my book, whatever carrying amount is there and exceeds recoverable amount, means how much it can fetch and how much it is carrying in the book. The differential, if it is fetchability is less than carrying amount, then we have to provide impairment. And the recoverable amount also I have already told, recoverable amount of an asset or a cash generating unit is the higher of its fair value less cost of disposal. Fair value, just above that we have already explained, fair value is when an orderly transaction I am selling something, so that is your fair value, and for making that sale I have to incur some selling and distribution expenditure, that is called cost of disposal, and its value in use. Value in use is a complex thing that I will cover in the letter with examples. So value in use is the present value of future cash flows. One asset is there, asset life is 10 years. So in 10 years, how much revenue every year it will generate? Let us say its EBITDA is 10 rupees in every year. So it is 100 rupees in totality it will generate. So 100 rupees present value is less than 100 as on date, because you have to do fair valuation, but its carrying amount is 100 rupees. So that is called the value in use, means that asset in future, how much every year it will generate revenue, and those future revenues present value is called value in use. So that we'll do with an example so that it will get clarified to everyone in my subsequent slide. This is the graph, just put your attention to here. Impairment test, your carrying amount is compared with your recoverable amount. Just in our earlier slide we have discussed that impairment, for impairment you have to compare your carrying amount with recoverable amount. And what is recoverable amount? Recoverable amount is higher of fair value less cost of disposal or cost to sell and value in use. In either of these two, whichever is higher is called as my recoverable amount, and recoverable amount is compared with carrying amount. And if the recoverable amount is more than carrying amount, then there is no impairment. If the recoverable amount is less than this carrying amount, then impairment attracts, and you have to put impairment in your books of account. Then an entity shall assess at the end of, just in my beginning I told that this impairment is a year-end activity. So how to do this test? An entity shall assess at the end of each reporting period whether there is any indication. Let us take one example. Suppose you have some health issue. So it will show that some health issue is there, and from that you come to know that my health is not good. If I am walking, running, eating, sleeping perfectly, then there is no indication that my health is any problem is there. If I am not able to do, then it is an indicator that something is wrong with my health. Then what you will do? You will go to a doctor, and doctor will prescribe you, go do this blood test, urine test, XYZ test, and you come to me. And after that, seeing that test, they will give you medicine. So this is basically nothing but this impairment testing is just like that. So for impairment testing, first you have to see whether any indication is there that telling me that yes, impairment is there, my asset is there. What indication it will give that management will think that yes, it may attract impairment, and those indicators will tend that the management will go and check test the impairment test. So at every year end, the management should see if any indication is there. If indication is there, just like you are going to doctor, the company will do the testing for impairment. If any such indication exists, the entity shall estimate the recoverable amount of the asset. Immediately you have to go and check your recoverable amount of that asset. Irrespective of whether there is any indication of impairment, an entity shall test an intangible asset with indefinite useful life or an intangible asset not yet used for impairment annually. Yes, for tangible asset, if there is indication, then only you have to go for testing of impairment. But for intangible asset like your goodwill is there, copyright is there, a lot of intangible assets are there in your books, patent, copyright, all are there in your books. But for intangible assets whose life is indefinite, there is no life is there. It is a perpetuity, it is lifelong, it will go in your books of account. There is no impairment. So what happening in those cases, you are not charging any expense for that use of that intangible asset. So if such type of intangible asset is there in your books of account having indefinite useful life, then at the end of the year, you have to mandatorily do testing the impairment irrespective of whether there is an indication is there or not. Similarly, any intangible asset not yet available for use, it is under construction is there, still you have to check whether there is indication is there or not. This is an exception to the standard. Then this impairment test may be performed at any time during the annual period, provided it is performed at the same time every year. Suppose today is March 23rd, 2022. Your management will tell that for that intangible asset, today we will test check the impairment because it is requirement of the standard. Whether there is indicator is there or not, you have to do the impairment. So today, 23rd March 2022, you are doing impairment for the financial year 21-22. Again, next year, 23rd March 2023, you have to go and test check that impairment. So it is telling, provided it is performed at the same time every year. Every year you have to go and test check on the same date whether impairment is there or not. Different intangible asset may be tested for impairment at different times, because today some impairment you have tested certain class of intangible asset. Tomorrow you will do a certain other intangible asset. Like that, different date you are testing the impairment. So for those assets, that frequency should be same date of next year to testing that impairment, irrespective of any indication is there or not. But if such intangible asset was initially recognized during, suppose today, this financial year, on 10th of March 2022, one asset, intangible asset under construction to put to active use has been used in the company's books. So what this has happened, because this asset has newly introduced in the books of account this financial year. So at the end of the financial year, you have to mandatorily test that impairment for that asset before the end of the current annual period. Similarly, goodwill, that also we have already told, goodwill on business combination is also a intangible asset, that also you have to test check as per the pronouncement of the standard. Then the ability of an intangible asset to generate sufficient future economic benefit to recover its carrying amount is the biggest challenge, because you don't know that whether it can realize the economic benefit. That is the main reason behind the testing of the impairment, and at least annually. So this is the logic behind this requirement, why you are doing every year. Whether doing a testing for tangible assets when indication is there, but intangible asset, whether indication is there or not, still you are doing the impairment testing, because it is the only motive that to just to have a sense that whether its economic benefit is there or not to recover its carrying amount. So basically, what indication I told, indication for impairment can be either external source of information, because when tangible asset you are going to test, you are first checking the indication. So how many type of indication there for an intangible tangible asset? Either it is an external source of information, means you are getting some information outside the companies, means in open market or anywhere else, not within the premises of the company or not within the control of the company. Or second thing is internal source of information within the company's certain information is there, that also attract your testing of impairment, or it may indicate for testing of impairment. And third thing is dividend from subsidiary, joint venture, associate. This third point is basically what I covered in my earlier slide. Your investment in subsidiary, associate and joint venture is basically investment, and it's a financial asset, and its impairment testing is also coming under the purview of Ind-AS 36. So for a tangible asset, external and internal sources are there. And for those investment, because investment is nothing but it's a third party investment, so you have to test check certain criteria like dividend, because you are investing for what purpose? Either you will investing for dividend earning or capital appreciation. So dividend is basically a indicator of your investment. If a dividend shows that your health checkup of your investment, if you are getting good handsome dividend every year, then you can assure that yes, my expectation or my cost of capital is 10%, I am getting 15% dividend, so there is nothing to do impairment testing, because what is my expectation, beyond that I am getting the return from my investment. So in that case, there will be no impairment. So those things also you have to test check for your investment in subsidiary, joint venture and associates. So in assessing whether there is an indication, there is an asset may be impaired, an entity shall consider as a minimum of the following indications. Just a while back I have told, this is the minimum of the test checking: external, internal and dividend in subsidiary or joint venture. So what are those external resources? Means external sources of information. Standard has prescribed certain situations, but it is not exhaustive list. Beyond that also management can go and test check if anything else is there. If there are observable indications that the asset's value has declined during the period significantly more than that would be expected. Suppose you have one asset in your company and you are using and you think that every year I should have depreciated 10%, but certain thing has happened in the external market, either it's a technical obsolete or change in technological market, or any economic environment has been changed, regulatory change, legal regulatory changes have made. It means that that asset that originally you were anticipated that 10 year I can run this plant or asset, now some changes are there, so you cannot use for 10 years. I think boss, it will complete within 5 years. So what you will do? You will do impairment testing for that, because your life is now not 10 year, now it has come down to 5 year, and that indicator tells that no boss, now I have to write down some amount, because this amount will not get fetched in the 10 year, it will be completed in 5 years only. So that is called your external information. Similarly, significant changes with this adverse effect on the entity that take place during the period or will take place near future, that is technological, market, economic or legal environment. If any change is there, that will restrict you, that your asset will not face what you are anticipating, then that amount you have to provide as impairment loss, because you have lost something. You have went to the market, you have put 1 crore rupees investment in a property, plant and equipment. You thought I can use it for 10 years. Out of 1 crore, I earn 2 crores, so 1 crore will be my profit. It was your anticipation or estimation. When a reality has happened, first year was okay, second year's technology has changed. That asset in next 2-3 years, it will get obsolete. So what you will do? Your anticipation of 2 crore is not now 2 crore. It has come down. So the differential of your anticipation and the reality has to be provided in the books of account as impairment loss. This is the fundamental of the standard. Hope my deliberations are clear to everybody. And third thing is market interest rate. Yes, when you are determining the value in use, I told you that future how much money you are going to fetch or generate out of the asset, you have to bring it down or discount it to present value. Suppose tomorrow, after 1 year, I will earn 100 rupees. Whether today's value is 100 rupees? No, today's value is not 100 rupees. If I'll put 90 rupees in the bank, 1 year interest added 10 rupees to that 90 rupees only. Next year, I can have a 100 rupees return in my hand. So 100 rupees of next year is not 100 rupees today. It has a time value of money. Today's 90 rupees is 100 rupees of tomorrow. So that 190 rupees, 10 rupees is your time value of money. So how you are discounting? You are discounting, taking through a discounting rate, and that depends on your market interest rate. So market interest rate, depending on that, you are deriving the fair value or the value in use as on date. If there is a change in market rate, means your lower is the interest rate, means lower is the discounting rate, the lower is the your higher is your present value. If it will increase, then your present value will come down. So market interest rate or other market rate return on the investment have increased. If there is an increase in interest rate, means your discounting rate has increased, so your present value will come down. So if come down, then it will be indicator of your impairment. And that discounted use in calculating asset value in use and decrease the asset recoverability. Means if that interest rate will increase, my recoverability will come down. So I have to test check that whether my present value is lower than carrying amount. So I have to go for impairment testing. I will give one example so that this point will get clarified. It is coming in the subsequent slide. The carrying amount of the net asset entities is more than its market capitalization. Suppose in your books, your net asset is your indicator, how much is your net asset in your books of account. But your market capitalization means your market price into number of outstanding share is less than that. That it means that your net asset is overstated. You have to take impairment on that. So these are basically your external indicators. By seeing that, one management can conclude that I have to test check the impairment. Similarly, internal source of information are there, like your physical damage to assets. Suppose one asset was there, physical damage has done because of accident. So it's now impairment has to be done, because it will not face to that period what we are expecting. Significant change with adverse effect of the entity have taken place during the period. So or asset becoming idle, plans to discontinue or restructure the operation. These are all indication of internal decisions. Suppose you are telling, I will not use this plant, I have to keep it idle because there is no market demand. So what you will do? The revenue generation of the asset will come down because now it is idle. So what you will do? You have to provide impairment for that asset. Similarly, discontinue or restructure the operation. Now you are telling, no boss, I will not run this operation for some time, I will stop. So the time gap for which you have stopped your business, the asset that supposed to generate revenue has stopped. So how to compensate that one? How that cost will be adjusted in the books? You have to do impairment. Plan to dispose of an asset before previously expected it. Suppose my initial estimation was there that 10 years this asset's useful life is there, but now I am thinking no, within 5 years I have to dispose it. So how to do? You have to do impairment. These are all indicators that is internal and subject to management. Evidence is available from the internal reporting that indicates that the economic performance of the asset or will be worse or than expected. You have made one budget. In that we are expected X amount. Now you are thinking no, it cannot reach X amount. Now it has come down. So this is also an indicator of impairment. So wherever your fetchability is not there, it will not earn what we are expecting as per budget. It is also indicator of impairment. So dividend from subsidiary. For an investment in a subsidiary joint venture associate, the investor recognizes a dividend from the investment, and evidence is available that if evidence is there, the carrying amount of the investment means in your book how much investment is there. The separate financial statement, because you know we are making SFS, separate financial statement, and CFS, consolidated financial statement, because your subsidiary will console in the separate financial statement of holding company, and that merger account is called as consolidated financial statement. So it talks about that the separate financial exceed the carrying amount of the amount in the consolidated financial statement of the invested net assets. Suppose the part of net asset is there plus goodwill on consolidation is there. If it is less than your investment, it means that your book means your separate financial statement, the investment was more what you can fetch from the subsidiary company. So it is a pure indicator that you impair your investment. Similarly, one more case may be that the dividend exceeds the total comprehensive income. Means suppose in 1 year you have earned 100 rupees, but you have paid 150 rupees to dividend. Suppose you and other shareholders. So what will happen? How much you have earned more than that you have paid. So it is also an indicator of that you go and check whether the company's real capability was to pay 150 in the profit of 100 because of accumulated surplus was there, or they have just of payment they have paid. If they have paid, also your investment will come down because you have received more dividend what you are expected to receive. So your investment has to come down. So in paragraph 12 is not exhaustive. These are the indicators very limited. So management, an entity may identify other indicators that an asset may impair. Also that also you have to take. And from that you have to conclude that whether impairment is not there and subjective to the management. Once an asset meets the criteria to be classified as held for sale, suppose one asset is there, its intention is to either to use or it has to be disposed. So when the management decided that we'll sell that asset, it will not there under PP, it will reclassify from PP to held for sale, that is Ind-AS 105, that is non-current asset held for sale. So it is excluded from the scope of the standard. Once it will categorize from PP, means property, plant, equipment, to non-current asset held for sale, then this impairment Ind-AS 36 is no more applicable to those assets because that has classification has been changed. Similarly, evidence of internal reporting, lot of evidences are there, like evidence from internal reporting that indicates that an asset may be impaired include existence of these 4 points they have given. That cash flows from the acquiring the asset or subsequent cash needs for operating or maintaining it, that is are significantly higher than those were originally budgeted. Suppose I have purchased one plant or machinery, I was thinking every year I have to incur 100 rupees for the repair and maintenance, but now it is getting 200. So that is also an indicator of impairment, because what you are anticipating, the actual expenditure is now more than that. So it may be also one of the indicators. Then actual net cash flow or operating profit or loss flowing from that are that budgeted. You are expecting out of use of the asset, every year I will earn 1,000 rupees, but now you are only earning 600 rupees. 400 whatever budgeted is now less, because based on that only you have procured the asset or acquired the asset. So now it is not up to your benchmark. So that differential also an indicator. You may also go and check the reality whether really it has impaired. So this is also one of the indicators. A significant decline in the budgeted net cash flows or operating profit, or significant increase in budget loss. Means budgeted, you are telling me this plant I have acquired, and from that every year I have earned 1,000 rupees, but now you are earning only 500. Means what you have anticipated you are not earning. Means something is wrong is there, boss. You have to go and check. That is called your impairment testing. Operating losses or net cash outflow for the asset when current period amount is aggregated to the budget amount. Means operating loss or net cash outflows of that asset. Means suppose today your operating loss is X amount and future amount whatever budgeted you are going to earn in totality, if I add, then that net cash outflow for that asset is not matching. Then also it is an indicator of your impairment. Then now, an indicator of paragraph, the standard requires an intangible asset indefinite. This has already I have told that indefinite is there, goodwill is there. Then the concept of materiality applies. No doubt in impairment, materiality concept is applied. And one example is that if previous calculation shows that an asset's recoverable amount is significantly greater than the carrying amount, the entity need not means suppose this year I have done a valuation and or calculation where my carrying amount is 500 rupees, whereas my recoverable amount is 5,000 rupees. There is a huge gap. So next year also I don't need to go and test check. If there is no event has occurred, that would eliminate the difference. Agar suppose any major incident happened, which the management will conclude, no, something wrong has happened. Now I have to check, then only you have to go check. Otherwise, if the gap is very massive, no need to go every year and go test check that impairment. That standard tells. Similarly, an illustration of paragraph 15, if market interest rate or other market rate of return of investment have increased during the period, as I have told you, if it is increased, then your present value will come down. So an entity is not required to, but in that case also it is not mandatory that you have to go and test check impairment if these two conditions will satisfy. What are those conditions? If the discount rate used in calculating the assets value in use is unlikely to be affected by the increase in the interest market rate. Suppose market rates are increased, but from those sources you have taken that borrowings or something, that will not change. Your outflow will remain same. So it will not impact you. Though in market rates are increased, but suppose you have hedged or you have taken a fixed rate, so that will not impact you. Though in market it has gone down, but for you it is exclusively not applicable. So in that case, no requirement of any impairment test. So for example, increase in short-term interest rate. Short-term interest rate has increased, but for asset, what you are doing? You are going for long-term loan. So in that case also, it is not an indicator for impairment. Similarly, one more case. If the discount rate is used in calculating assets value in use is likely to affect by increase in these market rates, but previous sensitive analysis of recoverable amount shows that the material decrease in recoverable amount because of future cash flow are also like to increase. Means recoverable amount means suppose I am telling one example. Suppose you are telling my interest rate has gone up, but with increase in that interest rate, suppose my revenue also will get generated. So if one instance your present value has come down, but that will be compensated by the inflow in the form of revenue. So in that case also, increase in discount rate may not always impact your impairment, because though your present value will come down, but with increase in inflation or interest rate, your revenue also you are getting increased. So that both are compensating each other. Rather, your revenue is more rather than the value in use. So in that case also, no need to do any impairment because you are on a safer side. The decrease in the recoverable amount is unlikely to result in material impairment. Very negligible change is there. Suppose that amount will not impact the reader of the financial statement also, you no need to do any impairment. So here materiality concept also runs. Similarly, paragraph 17 tells if there is an indication that an asset may impair, this may indicate that the remaining useful life, the depreciation method or the residual value for the asset need to be reviewed. If you are putting one impairment for the asset, then your residual value and your depreciation with pattern of consumption method is required to be reviewed. And if no impairment loss is, even if there is an indication and you are not taking any impairment loss, still the management is advised to test check the residual value and the and in the form of depreciation or method you are used, that you have to review, even though you are not charging that impairment for that asset, but still you have to go and review because it's a highly suggestive. Then paragraph 18 and 19, that is telling the standard defines recoverable amount as the higher of an assets or cash units, cash value is cost over disposal and the value in use. Either of the two, whichever is higher, that is called your recoverable amount. And paragraph 15 to 19 sets out the measuring of how to do. These are the paragraph reference numbers, which paragraph talks what. The requirement use the term an asset, but apply equally to individual asset or cash. Earlier I have told one individual asset if independently can generate cash, that is also a asset subject to impairment. Or if 10 assets getting together only can earn, that is also known as cash generating unit, because individually one asset independently cannot generate revenue. So it is not always necessary to determine both an asset's fair value less cost per disposal and value in use. What logic it is that because how you are doing your impairment test, you are testing your carrying amount with your recoverable amount, and recoverable amount is higher of your fair value less cost per disposal and value in use. If your value in use when you are determining it itself is more than your carrying amount, so what is the need to go for test check the fair value less cost of disposal? Because if my carrying amount is 100 rupees, value in use is 200 rupees, itself this 200 rupees is more than carrying amount. So no need to go and test check whether my fair value less cost of disposal is how much, because itself one component is more than the carrying amount. So one component is higher means no need to check the impairment test. Just 1 minute. Yeah. Now it may be possible to measure fair value less cost of disposal even if there is no quoted price on active market. Means how to determine that. However, sometimes it is not to be possible to measure the fair value less cost of disposal. In that case, the entity may use the assets value in use as its recoverable amount. Suppose it is not possible for you for a particular market or particular asset to determine how much is fair value less cost per disposal. In that case, you can use your value in use as your recoverable amount. So no need to go for doing that because that cannot be done. Similarly, if there is no reason to believe that an asset's value in use materially exceeds its fair value less cost of disposal, the asset's fair value less cost of disposal may be used in its recoverable amount. The same thing that is it is telling. This will often be a case for an asset that is held for disposal. When you are putting one asset you have kept for disposal, you will not basically go for computation of value in use, because you will always do your testing should be fair value less cost of disposal, because you are now you have intent of the management to dispose that asset. Mainly of the net of disposal means net disposal proceed means always your fair value less cost of disposal is your recoverable amount. So that you have to carry with your carrying amount. Similarly, recoverable amount is determined for an individual asset unless the asset does not generate cash inflow that is largely independent, that I have already told, unless either the asset's fair value, this as I have already explained in my earlier slide, so no need to deliver it again. Cost of disposal other than those that have been recognized as deducted measuring the fair value less cost of disposal. You have to reduce from your sales proceed. For example, one example is that legal cost, stamp duty, similar transaction. These are all the transaction cost, or that is called your cost of disposal, like your legal cost, stamp duty, other taxes. Removing the asset, maybe some removal cost you are required, manpower you are required, direct incremental cost being asset to condition sale. So these are the example of cost of disposal. However, termination benefit that standard prohibits that termination benefit and the cost associated with reducing or recognizing a business are not direct incremental cost per disposal. So as per Ind-AS 19, any employee benefit for termination benefit, suppose one unit is there, you are disposing, for that employee you are paying some compensation, BRS, retrenchment, those things will not consider as your disposal cost. Only your legal, stamp duty, whatever is written above as the part of cost of disposal. Similarly, the following elements shall be reflected in the calculation of asset value in use. This is very important. What are the components that really impact the value in use? Because value in use is the only thing that we often call as VIU, is a very critical thing. An estimate of the future cash flows. So for value in use, what factors you are required to be computed? One is how much future you are going to generate cash from that asset. Expectation about the possible variation. If any variation is there, you have to take care in the projection. The time value of money, because I told that you have to discount the future cash generation to present value. So time value of money is very important. And basically it is nothing but the current market risk-free rate of interest. And similarly, the price of bearing the uncertainty inherent in the asset. That also I told, if any uncertainty is there, that also you have to compensate in the cash flow, so that a real sense of projection should be there to compute the reality of the value in use. Other factors such as liquidity that market participant would reflect in pricing the future cash flow entity expect derived from the asset. These are also you have to take care of in your cash flow projection. And the estimating the value in use of an asset involves the following: estimating the future cash inflows and outflows, both how much revenue you will earn, how much expenditure you have to incur, both you have to take. And basically that bottom line, based on that, you are deriving your VIU is nothing but earning before EBITDA, earning before depreciation, interest and tax, to be determined from continuous use of the asset and from its ultimate disposal. So let me just clarify you. Suppose one CGU is there and you are going to compute the value in use. So what you will do? You have a recent board approved budget or financial forecast is there. In that you have your revenue, you have your expenditure. So you just compute the EBITDA and project it for next 5 year or 10 year, depending on this scenario, and take a discount rate. And after 5 years, suppose whatever your WDV or terminal value of that asset is there, that also you take in the computation, and you present it to the present value, means do the fair valuation and bring it to the present value. Then compare with the carrying amount of that asset. If that value in use is more than the carrying amount, then there is no impairment. In the reverse case, impairment will be taken care in the books of account. Applying the appropriate discount rate is the very challenging thing, because depending on the discounting rate, only your value in use amount will get determined. So discounting rate also you have to take very prudently. And under the guidance note, they have also told how to take the discounting rate. The elements identified in paragraph 30B, just we have explained the just earlier slide, can be reflected either as an adjustment to the future cash flows or adjustment to the discount rate. So these three things, either what it tries to tell is that either this impact you can take in the future projection of the revenue or expenditure, or you can compensate that in the discounting rate. Suppose in sales you will increase, discount rate no need to decrease. If that you are not taking, you have to do it here. You don't need to do in both sides. Either the real picture of the future projection should have been there in your value in use computation. So either suppose that some impact is there, either you increase your revenue so that your value in use amount will increase, or reduce the discount rate so that also your value in use amount will also increase. So that it is telling key, either you can do here or adjustment to discount rate, either of the two places, not both places. Whichever approach an entity adopts to reflect the expectation about the possible variation in the amount or timing of future cash flows, the result shall be reflect the expected present value of the future cash flow. That what I have told, either you adjust there or in the discounting rate, but it should give a true picture of your expected present value of future cash flow. That is a weighted average of all possible outcomes. That is the only crux of the story. And Appendix A, which talks about how to determine the value in use, that you can refer in the standard. It has given the exhaustive guidance note how to the value in use. In measuring value in use, an entity shall do base cash flow projection on reasonable and supportable assumption. Yes, this is the main thing what everybody should understand. What is this? Suppose your auditor will come to you and they will ask whether there is indicator for impairment of a PP. Your management will test check that paragraph 12 and they will tell yes, some indicators are there. So now they will ask, just give me your computation or test checking of your impairment. So what you will do, you have to give them the carrying amount, recoverable amount. For recoverable amount, you have to go for your value in use. While arriving value in use, you have to give your projections, financial projections. But projection cannot be any rosy figure or any arbitrary figure. There will be certain reasonableness and supportable assumption. You cannot put any figure as per your wish. You have to give all backup document for every component of your projection. How much your revenue projection is there, how much the growth parameter is there, quantity, how much your other parameters, your sales, customers, your expenditure pattern, how your raw material get impacted, how your other operating expense will get impacted. Everything you have to have a very delicate and composite working papers for everything. Otherwise, your auditor may raise 100 of queries on that, and your value in use is nowhere. So standard very pertinently tells that reasonable and supportable assumptions should be there. Supportable means documentary evidence should be there with you. If I have taken the interest rate discounting rate 10%, you have to have the document which talks about that yes, this company can take 10% for this projection. So all the supportable assumption with document which should be there for your audit purpose. That represent management's best estimate, and management should do the best estimate what best can they project for their future cash generation. And it is not a rosy picture, rather it should be very prudent and supportable evidence should be there for that all projections that will exist over the remaining useful, because projection is not for today, it is you are doing for next 4, 5, 10 years. So greater weight shall be given to external evidence. If any external evidence is there, then your more weights shall be given and more those things should be considered in your projection, not your internal assumption. Similarly, base cash flow projection on the most written financial budget or forecast approved by the management. Here the real game starts. It is not that your management will show some piece of paper and told you, boss, this is my projection. No, you have to take it to your board and your audit committee, and your auditors should also vet that one. Yes, it has been approved by the board, so that it is a prudent document and that can be used for your projection. Not that your management will do any projection and show to the auditor, this is my projection, which talks about the value in use. Nobody will accept that one unless until it is based on the budget or forecast approved by the management. Management means here what we can say should be through audit committee and board or any other appropriate body created by the company, but shall exclude any estimated future cash inflow outflow expected to arise from the future restructuring or from improving or enhancing the asset performance. Yes. What exactly it tells? Suppose you have a plan after 3 years, I will do this capital restructuring so that my revenue will increase. But today's date, you are not committed to those restructuring, or neither you have paid anything for that. So in your projection of those periods, you cannot take the advantage of the incremental revenue or incremental cash flows to the company, because neither you are committed for the restructuring nor you have made any cash outflow. So while doing the cash flow projection, you have to do on a conservative side. You cannot take any benefit for the restructuring, that is to future restructuring, and that will enhance the asset performance. Tomorrow I will do some revamping of my asset and my product quality will increase and it will fetch more revenue in the market. Boss, you are not allowed to do. You cannot take those shelter and you cannot do your projection. So standard prohibits, you cannot take that one. Projection based on those budgets or forecasts shall cover a maximum period of 5 years. Yes, unless a longer period can be justified. This is the main requirement of the standard. This 5 year, every company, this challenge come, because it tells you cannot take projection for more than 5 years. Maximum you can take 5 years. If you want to take more than 5 years, you have to prove that earlier projection were very realistic. What projection you have made is almost actual level. Then only your auditor will allow to take projection more than 5 years. Otherwise, market is very volatile. You cannot predict more than 5 years. This is the assumption of the standard. Standard tells future maximum one management can view for next 5 years. More than that they cannot do. How they can do? If their earlier projection and actual, there is no significant difference, then only your auditor will allow to do a projection for more than 5 years. Unless otherwise, your auditor will restrict to 5 years only. They will not allow more than 5 years. Estimate cash flows projection beyond this period covered by the most recent budget or forecast using a steady or decline. Yes, when your budget is for only 1 year, so how to the projection for the next 4 or 5 years? They are telling using a steady or decline growth rate. Either you take the same growth parameter, or rather on a conservative side, you take a negative or decline growth rate for subsequent years. Unless an increasing rate can be justified. Just like I told you, your management had to demonstrate to your auditors, yes, boss, we have taken this incremental rate because I can demonstrate these things. Something is going to happen in the market. My revenue will increase. My cost will come down. All this backup document with supportable evidence, they have to produce before the auditor so that they will agree to your projection. Otherwise, they will reject your projection. And it happens every company. This growth rate shall not exceed the long-term average growth rate. And suppose you are taking a growth rate also in those industry or the country or the entity operates in that industry or the product, what you are using in those field, what is the long-term average growth rate, that only you can take. Beyond that, you cannot take, but unless a higher rate can be justified. Everything depends on your demonstration, how you can demonstrate. If you can demonstrate better, then only standard allows you to take a higher. Otherwise, entire standard runs on a conservative accounting. Similarly, management assess the regionalness of the assumptions. Whatever assumption you are taking, there should be a firm reason behind those assumptions. Otherwise, nobody will allow you. Examining the causes of difference between the past cash flow projection and actual cash flow. Earlier, last 4 or 5 years, what budget you have made and what actually you have achieved, that is only the litmus test or test check for your future projection and confidence about your more than 5 years. If earlier year I projected a profit of 100 rupees, I earned a loss of 200 rupees. No boss. Now your projection is only a for namesake projection. There is no guarantee that it will happen. So do a short-term projection. Don't go for long-term projection. No auditor will allow you. So auditor, while checking that long-term reserveness or the more than 5-year projection, they will check in the past what was the actual performance of the company vis-a-vis what forecast or budget made by management. If it is near same or very negligible difference is there, may your auditor allow you to go for a higher projection, means more than 5-year projection. Otherwise, they will not allow. And management shall ensure that the assumptions on which the current cash flow projections are based on the consistent with the past actual outcomes, provided the effect of subsequent events. Yes. Suppose some events have happened that was not there earlier, and now it is evident that these things has happened, and you can demonstrate. Then you can take a higher projection, or you can do a better projection. For that, you have to have a subsequent event of circumstance that did not exist when actual cash flow was generated, make the appropriate. So that you can shelter, you can take. For that, you need to have a evidence. Similarly, explicit and reliable financial budgets or forecast of future cash flow period of longer than 5 years generally not available. So more than 5 years they will not give. Over a period of longer than 5 years, it is confident that these projections are reliable and it can demonstrate its ability based on the past experience. Just a while back I told, auditor will not allow you to make any projection beyond 5 years. Take it granted, all companies are restricted to 5 years unless until, like IOCL, in their impairment, if you check, they have taken 15 years. What does it mean? It means that their management is pretty confident and their earlier budget vis-a-vis actual performances almost same, and they can demonstrate to the auditor that was, if I can project 15 years also, there will be no impact, because earlier also what projection I have done, I have achieved the near to that or more favorable to that one. So that way your auditor will only allow, otherwise they will not allow you more than 5 years. So this is very practical scenarios. If you really work in industry only, you can understand the reality of these 5 years, discount rate, disposal cost, terminal value. Once you reality in work in industry only, you can understand the logic behind these assumptions. Cash flow projection until the end of the asset's useful life. Yes. So this paragraph 36 also gives key. Suppose your asset life is 25 years. Suppose power plant, power generating unit, its life is 40 years as per the Schedule 2 of Companies Act. So 40-year projection is it is not allowed. So how to do? Because you will get benefit unless until the asset's useful life is over. So after 5 years, whatever balance period you are projecting, it is nothing but your terminal value of that asset, because it will give you a consistent income, and that income may be on a flat rate or decline rate on the what you have achieved on the 5th year. So this is basically the context. This is the requirement of this standard. And if it's telling if you are doing that one, it is appropriate that the growth rate is 0 or negative. Here you see the 0 or negative. So 5th year onwards, suppose 5th year your EBITDA is 500 rupees. So 6th to up to the end of the useful life of the asset, either you take 500 or you take a negative, means reduction rate. You cannot take more than that. This is the paragraph 36 is telling, and paragraph 36 is very important. When conditions are favorable, competitors are likely to enter the market and restrict growth. This is also one story. Today you are doing something, there is no competition. Tomorrow competitor will come, your market will get squeezed, your revenue will come down. Therefore, the entity will have difficulty in exceeding average historical growth rate over the long term. So this also I have already told you. What are the reason behind that? You cannot take more than that rate. Similarly, in using information from financial budget or forecast, an entity consider whether the information reflects reasonable and supportable assumptions and represents management's best estimate. So whatever management best estimate is there, estimate is then up by the board or audit committee, is only subject to be considered in the cash flow for value in use. So this you have to take. And sometimes some auditors, if they want, they also can go and check whether what projection you have made in the budget, what assumptions you have taken. If there also you fail, there also they will make surgery in your projection. So get ready for that also. If your supportable assumptions or documents are not there, though it is approved by your board, auditor will not agree. They may also change that one. Projection of the estimates of future cash flows shall include projection of the cash inflows from the continuing use of the asset. So this is the basic criteria of this thing, and projection of cash outflow. So both inflow, how much you will earn, and how much you incur, that are necessary to incur. It means for generating the revenue, how much cash outflow you have to take, that also you have to take. And the net cash flow, if any, to be received on paid on disposal of the after the useful life. Suppose after selling that asset, you will get X amount. That benefit also you have to take in your projection. That standard tells you. Similarly, estimate of future cash flow and the discount rate reflect consistent assumption about the price increase attributable to general inflation. So this discount rate should be linked with your general inflation rate. It cannot be a arbitrary figure. Therefore, if the discount rate includes the effect of the price increase attributable to general inflation, future cash flow are estimated in normal terms. And if discount rates are excluded, the effects of the price increases attributable to general inflation, future cash flows are estimated in real terms. Similarly, projections of cash outflow include those for the day-to-day servicing of the asset, as well as future overheads that can be attributable directly. Means to run your refinery, there need to be some day-to-day expenditure like R&M is there, chemical catalyst is there, salary wages is there. These are all things are taking as a part of your servicing, and it should not be treated otherwise. When the carrying amount of asset does not yet include all cash outflows to be incurred before it is ready to be used, then the estimate of the future cash flow include the estimate any future cash outflow. Suppose today one asset is under construction. So today you know that asset under construction also subject to impairment, that is under Ind-AS 36. Means your capital work in progress also you have to test check whether an impairment is there or not. So how to test check? For that capital work in progress, you have to also test check same way how much it will revenue generation is there and how much cost incurred to generate those revenue. But for that CWAP, any leftover portion is there, any amount of expenditure is pending that is required to be incurred before the use of the asset. There also you have to consider in the cash flow, so that the real picture will come, because those amount is yet to be incurred to put the asset to use. So for example, this is the case of a building under construction or for a development project that is not yet completed. If it is not completed and you are testing impairment, if anything pending expenditure is there that you have to incur to put the asset in put to use condition or usable condition, those expenditure also you have to take in your cash flow projection. Similar to avoid double accounting, estimate of future cash flows do not include cash inflow from asset that generated cash inflow that are largely independent of the cash inflows from the asset. For example, what it tells that suppose in cash flow projection, what you will take, how much operating income is there and operating expenses there, only those items you have to take. Suppose in my book some trade receivable is there, whether it will impact my operating profit? No, because it is a performance of earlier period. Though cash is coming, but it is not related to that operation. So any trade receivable, specifically like receivables, it should not be part of your cash flow projection. Similarly, any obligation of payables or pensions or provisions are there, that is also old period things. Though cash outflow is there, but it is not related to your performance of that asset. So those things are not required to be included, because otherwise your cash flow will be deteriorated. Future cash flow shall be estimated for the asset in its current condition. No future restructuring can be considered. The condition today the asset is running, in those conditions also you have to do the projection. You cannot take a very rosy or picture of future that I will do something, from that I will earn that much amount and I will take in my cash flow projection. No. As on date, the condition in which the asset is running, how much it can earn and how much it is incurred to run, that only you have to take. Estimates of future cash flows shall not include estimated future cash inflows or outflows that are expected from future restructuring that is not yet committed, or improving or enhancing asset performance. Anything in future you are going to do, you are not supposed to consider in your cash flow, and if you put also, your auditor will reject that one. Similarly, because future cash flows are estimated for the asset in your current condition, the value in use does not reflect any the cost savings. Means suppose in future you will do some revamping or capital expenditure so that your cost will come down, cost of operation or cost of production will come down. The benefit that are expected to arise by future restriction not yet committed, you cannot take. You have to take as on date to run that plant and machinery or asset or CGU. How much real cost is required, that only you have to take. You cannot say that in future I will do these things so that my cost of production will come down and I will not take it now. That shelter is not there for you. and improving or enhancing asset performance or related cash inflow. You are strictly prohibited to take all those things. Nobody will allow you. When an entity becomes committed to a restructuring, yes, if you are committed to a restructuring and you have paid the cash outflow, then future cash inflows and cash outflows for the purpose of determining value use reflect the cost of savings and other benefit from the restructuring and estimates of the future cash outflows for the provisioning. Means, suppose I will do one capital restructuring, I have been committed, orders have been floated, payment has also been made, then that benefit you have taken, but it's estimated future cash outflow for the restructuring under Ind-AS 37. Any provisioning is required to be made, that also you have to take. Until an entity incur cash outflow, just a while back I told, for future restructuring, until and unless the cash outflow has been done for that improvement or enhancement of asset performance, do not include in the estimated cash flow. If it is not, outflow is not done, then in cash outflow or inflow, you cannot take that economic benefits. So if you are committed, orders have been flowed to the vendor, you have made the payment, then only in the future projection you can take the benefit. Otherwise, you cannot take that. That standard prohibits under your paragraph 48. Similarly, one more paragraph 49, which talks about estimates of future cash flow, include the future cash flow necessary to maintain the level of economic benefit expected to arise from the asset in current condition. Means, to run the asset, you have to incur certain expenditure. So what happened, suppose one, I am giving one live example. Suppose one asset is there, a big asset is there, and that asset has certain components, and that component's useful life is lower than the main asset. And over the useful life of the main asset, 2-3 times you will replace that component. So you cannot say that is a capital restructuring. It is a part of your operation and you have to take that in the cash flow projection. Similarly, suppose 10 assets are running together and earning revenue, and out of that, one asset's useful life is less than other assets, and that will go and a new asset will come. So you cannot say that is a capital restructuring, it is a part of your operation only. So here, that's why it is telling ki cash outflow necessary to maintain the level of economic benefit expected to arise from the asset in its current condition, different estimated useful life. The replacement of asset with shorter life is considered to be part of day-to-day servicing. It is not a capital restructuring. It is a revenue expenditure. Single asset consists of component with different estimated useful life, the part of day-to-day servicing cost. Means asset or component, if it is replacing in the operating cycle, it cannot be tantamount as a capital restructuring. So that will be treated as a part of the operating expenditure only. Similarly, paragraph 50-52, estimated of future cash flow shall not include financing activity. Means finance cost and income tax are strictly prohibited from the computation. That's why I told your bottom line for the VIU or value in use computation is EBITDA. Means earning before depreciation, interest and tax. So this finance cost and EBIT, that is your earning before interest and the tax. So tax and finance cost you cannot consider in the projection. The estimated of net cash flow to be received or paid for the disposal of asset at the end of its useful life shall be amount of entity expected to obtain from the disposal. That I have already told. Suppose you are selling that asset at the end of the useful life. After that, by disposing that, some disposal proceeds will come to the entity. So that also amount you have to include in your cash flow. That benefit you have to add back in your revenue, so that it will give a real picture. Then second, that fair value differs from fair value in use. Fair value reflects the assumption market participant would use the pricing of the asset, and in contrast, value in use reflects the effect of the factor that may be specific to the entity. So this I am not going into it. Additional value derived from the grouping of asset, synergy between the asset, legal rights or legal restriction, tax benefit. These are all the things that we have to consider in your cash flow projection. So this is a composition of estimate of future cash outflow. So these things you have to take. Similarly, discount rate. This is also one of the parameters for deriving the value in use. So the discount rate shall be the pre-tax rate. It cannot be post-tax rate. And current market assessment of the time value of the money. What is the industry or the entity specific rate? Means how much the equity shareholder expecting, how the loan provider expecting, and how much they are supposed to pay out. That only weighted average cost they have to take, and that will take care of time value of money and risk specific to the asset. Both things would be considered in the discount rate. That standard is very clear on that. Similarly, if and only if the recoverable amount of the asset is less than the carrying amount, now question comes, how impairment loss is booked in the book. Suppose the recoverable amount of the asset is less than its carrying amount. The carrying amount of the asset shall be reduced to a recoverable amount, and that reduction is impairment loss. Your carrying amount in books is 100 rupees. Your recoverable amount is 50 rupees. So your recoverable amount is less than your carrying amount. So your impairment loss will be 50 rupees in the books of account. That is called that reduction in impairment loss. So an impairment loss be recognized immediately in the profit and loss. When you determine after testing that impairment is there, immediately debit to your profit and loss as impairment loss. And in your schedule 3, if you see, impairment loss is basically exceptional in nature. So they are categorized under exceptional expenses only. Unless the asset is carried out revalued amount in accordance. So revaluation is there. This accounting treatment is routing through OCA. So this is different. If revaluation model is not there, cost model is there, you have to debit to P&L. Similarly, an impairment loss on a non-revalued asset is recognized profit and loss. I am telling if it is cost model or non-revalued asset, then recognize P&L. Revalued asset is recognized in other comprehensive income to the extent that the impairment loss does not exceed the amount of revaluation surplus. So earlier, suppose you have made some revaluation surplus is there. Suppose one asset was 100 rupees. You went for revaluation. Revaluation was 150 rupees. So you increase 50 rupees in your asset. So tomorrow, if your loss is 50 rupees, then that you have to reduce. But the gain cannot be more than your loss. So that's why it's telling a revalued asset is recognized in other companies' income to the extent that the impairment loss does not exceed to the amount in the revaluation surplus. So in that revaluation surplus adjustment, maximum to the tune how much you have revaluation surplus you have taken to maximum tune you can take, not beyond that. That standard prohibits. Such an impairment loss or revalued asset reduce it to revaluation surplus for that asset. What I told you just a while back. Similarly, when the amount estimated for the impairment loss is greater than the carrying amount of the asset, means suppose your carrying amount of the asset is 100 rupees, but your impairment loss is 150 rupees. So where you will put the extra 50 rupees? So it standard tells recognize a liability of 50 rupees and only if they required by any other standard. If any other standards talks that suppose Ind-AS 16 is telling 37 is called decommissioning cost. Suppose that asset after decommissioning 50 rupees extra is there that you have to incur when you will do the decommissioning, then that also you have to provide as a liability if that has not been taken care in the asset earlier. So that also you are telling if other standard provide, then you have to take that liability also. Means your asset is 100, impairment 150, 50 rupees extra liability provide for future commission, future commitments. After the recognition of an impairment loss, the depreciation means charge to assets shall be adjusted in future period to allocate the assets revised carrying amount. So this is the same thing. If you are putting any impairment, your useful life and your depreciation pattern or residual value is required to be reviewed on a systematic basis for the remaining useful life of the asset. So this is the one graph I have made because your value in use basically depends on the 4 parameters: future cash inflow and outflow, that is your revenue and expenditure. Projection period, whether it is 5-year, 10-year, 15-year, based on your demonstration. Discount rate, already I have told. Residual value means after disposal of asset, how much earnings you will make out of that. These 4 components basically takes care of value in use. So this you have to take very critically, this 4. So now after completion, now we'll do one case study for 5 minutes. You see, I have taken the accounting policy of Tata L&T, where it talks about how the impairment of asset is they are doing. You can see at the end of each financial year, the carrying value of PPE, investment property, intangible asset invested in subsidiary, associate and joint venture are reviewed to determine whether there is any indication that the assets have been suffered impairment loss. And if such indication exists, PPE investment property means the same thing what I told. If indicators is there, then you have to test, and if it is impairment is there, then you have to put. And impairment loss recognized when the carrying amount of the asset exceeds the recoverable amount. That already I have told. Recoverable amount is in case of individual asset are the higher of the value less cost of sale, or in case of cash generativity, because either you can take individual asset or group of asset, that is called CGU. Both things they have written. The amount of value in use is determined at the present value of the estimated future cash flow. That in an example I will do. So the same thing what we have read up to now, this policy is there. I will share with you. You can also go for other companies' accounting policy for impairment of asset. Whatever today we have read, all these things you will get there. So based on that, they are doing the impairment test. So now let us come for a live case study. Suppose one industry company is there, one asset is there. Here, if you see the written down value, I have taken, suppose in case 1, 3,000, and this is your value in use. If you see discounted cash flow, value in use, I have done. How I have done? I have made a projection for next 5 years, means 22, 23, say 26, 27. 5 year I have taken a projection where discount rate is I have taken 10%, And when time value of money, that I have told 1 rupee of today is 1 rupee of tomorrow is not today 1 rupee, it is 91 paisa. And 1 rupee of day after 2 years, it is today 83 paisa. So the same logic, I have made the discounting factor, and the cash flows forecast net I have taken, because I have taken care of both inflow and outflow. Suppose from that asset you are getting 500 in the year 1, 550 year 2, 600 year 3, 650 year 4, and 700 year 5. Similarly, I have told residual value also. Residual value means after disposal of the asset, you will get 100 rupees out of the disposal. So what I am doing the same thing what I have told here. Future cash flow, inflow, outflow I have taken. Projection period 5 year I have taken. Discount rate 10% I have taken. Residual value I have taken 100 rupees. So all these 4 parameters I have taken. And based on the parameter, now I am going to compute the value in use. So the value in use, how I am determining. So the net cash flow from this event 500, 550, 600, 650, 800. But the 500 what I earn 22, 23, today its value is 455 rupees. This value is 455, 451. So the net amount proceed of 3,100 in the future is today's value is 2,301 rupees. So now how to, this is called your VIU or value in use of that asset, because your future revenue generation of the asset, taking all the factors, your discounted or value in use is now 2,301 rupees. So now how I compare the impairment? I will go for the, I have taken 4 cases. Suppose in the first cases, the WDB or carrying amount is 3,000 rupees of the PPE. So now this 3,000 I will compare with whom? I will compare with the 2301. So if my carrying amount is more, my value in is less. So how much impairment I have to take? I have to take an impairment or loss of 700 or 699 rupees in my books of account. Similarly, in case 2, if my written down value is 2,500, but the value in use is 2,301, so impairment loss will be 199 rupees. Case 3, my WDB is suppose 2,301, whereas my value in use is 2,301, so there will be no impairment because your carrying amount and value in use both are same. But in case number 4, your written down value is 2,000 rupees, whereas your value in use is 2,301. Means your asset is in book 2,000, but the benefit you are going to get out of the asset is 2,300. So how much extra you are earning? 301. So for that, there will be no accounting. You have indicator, you test check your value in use, and it shows that in case number 4, there is no impairment is required. Whereas in case number 1 and 2, it talks this much impairment you have to take in the books of account. So this is the main crux story of value in use. So hopefully everybody have understood how we are computing the impairment factors we have considered and how we are taking the value in use, because this is the more challenging part in any industry you go. You have to do the value in use working at the end of every financial year for your cash generating unit or individual asset based on the case. And you have to test check your impairment, and you have to give this working to your auditor so that they can vet that whether any impairment is required for that company or not. So this is a very crucial computation, and every professional should know how we are doing impairment testing for an industry. So now, as I told that today I will cover 2 standards. So my part 2 is now Ind-AS 8. Himo sir, how much time further I can take?
Maximum 15 to 20 minutes.
Okay, done.
Okay.
So now let us come to the concept of accounting policies, change in accounting estimate and error. How many of you have seen accounting policies of any company? You go to any company's annual report. It's my suggestion to all members and students. Just go to the annual report of any company. After the audit report, independent auditor's report, first you will get a statement called statement of change in equity. That very fondly we call it SOCI. If you go to Indian Accounting Standard 1, it talks about what is financial statement. Financial statement, it talks your statement of change in equity, your statement of profit and loss, your statement of asset or liability, or it is called balance sheet, cash flow, and significant accounting policy. This 5 concept is called as your financial statement. So in that, one of the component is your accounting policy. So your statement of change in equity, your statement of profit and loss, statement of asset liability, that is called balance sheet, your cash flow, statement of cash flow, and the significant accounting policy. These 5 are financial statement, One of the component is accounting policy, and we'll see how the policies are being framed. And if you see the annual report, this is the chronological order. So see, then balance sheet, then P&L, then cash flow, then your accounting policy, and the notes or notes to the significant accounting note also forming part of your accounting policy. So P&L, balance sheet, and its note also include the part of the financial statement. So now let us see what is accounting policy, what is change in accounting estimate, and what is error. These three components are there. That is Ind-AS 8. That now I will cover. So before going to that, this standard has total 54 paragraphs and two appendix, Appendix A, Appendix 1. Appendix A basically reference to matter contained in other accounting standard, and Appendix 1 basically talks about the comparison of IAS 8, because earlier I told IAS 8 as not now Ind-AS 8 in Indian context. So Appendix 1 also talks about the comparison of IAS 8 and vis-a-vis Ind-AS 8. So basically these three concepts are there. Your accounting policy, change in accounting estimate, or you can tell that policy, estimate, and error. Three components we are going to cover. So accounting policy, broadly it has 6 heads, like your definition, selection and application of accounting policy, consistency of accounting policy, change in accounting policy, applying change in accounting policy, and disclosure. So what are those definitions are there in for accounting policy? How to select and apply the accounting policy, because to apply an accounting policy you have to select where from you have select, how you will select, and consistency of accounting policy, because you know consistency in accounting is always required. Whatever you are doing, there should be consistent practice, not that today you are doing something, tomorrow you will go do some other thing. So what will trouble it will give that, suppose one reader of financial statement is there, today something you are doing, the next year you will do something. So the comparability is a very fundamental requirement of financial statement. So if consistency will not maintain, then the reader will get misled, because today he is reading something and tomorrow in the different financial statement he will read something. So that's why this standard talks about that consistency in the accounting policy should be there. Otherwise it may mislead to the investor. Similarly, change in accounting policy. When change in accounting policy is required, why you will go when you are framing one accounting policy? What will make you to go for a change in accounting policy? Those also things are covered in the standard. Then applying change in accounting. If you are changing, how to apply that change in accounting policy? What you will do in your financial statement? All those things have been told in this standard also. Similarly, if you are changing anything or accounting policy, what disclosure you are going to give? That also this standard covers. Now accounting estimate. What is estimate? Estimate is a judgment. From judgment you are doing estimate. Suppose you are telling I have purchased an asset and its useful life is 10 years. Whether really it can run use for 10 years? No. From the day 0, it is only your mere estimation. Going forward, as Ind-AS 16 tells, at the end of every financial year, you have to go and review 2 things of your PP. One is its residual value, one is its depreciation pattern. You have to go and you have to test check. If it has any changes there, you have to give that effect in the books of account, and that will tend to amount to change in accounting estimate. So accounting estimate also has covered into 5 segments. Meaning of the accounting estimate, a reason for change in accounting estimate, accounting for change in accounting estimate. Suppose if there is a change, how to account for that one, and change in accounting policy and disclosure. Suppose any estimate you are changing, what policy you will change? Because if you are changing useful life, you are changing whether any policy covered is there, that also it is there. Then error. Error can be 2 types: deliberate intentional error, unintentional errors, and fraud is also, because we are telling fraud and error. Standard also covers fraud in this error paragraph. So basically it covers definition, type of errors, how many type of errors someone can commit, accounting treatments of error. If you have made one error, then how to do the accounting treatment, and what are those disclosures are required, that also covered here. So the objective of the standard is to prescribe the criteria for selecting and changing accounting policy. This accounting standard Ind-AS 8 not only talks about your accounting policy, but it also talks about how to select an accounting policy. Together with the accounting treatment and disclosure of change in accounting policies, change in accounting estimates, and correction of errors. So basically what it covers: how to select one accounting policy, how to change an accounting policy, and the treatment and disclosure for change in accounting policy, change in accounting estimate, and correction and or error. All these things have been covered in the accounting standard 8. This standard is intended to enhance the relevance. Just a while back I told you why this standard is there, because the standard wants to enhance the relevance and reliability of entities' financial statement. If you maintain all those things, your financial statement reliability is more. Your investor will not get misled. Their investing decision for that particular company is in a prudent way, means you are doing justice to your investor. So that, and the comparability of those financial statement over a time with the financial statement or other entities. So either you can compare within the entities, or you can compare by taking the financial statement with the other entities. If there is a consistency is there and these three things are done or dealt diligently, the standards shall be applied in selecting and applying accounting policy. As I have told, this standard also will guide the management how to select and apply the accounting policy, and accounting for changes in accounting policy, changes in accounting estimate, and correction of prior period errors. So all these four things, it will guide this standard. So what is accounting policy? Accounting policies are the specific principles, bases, conventions, rules, and practices. What 5 factors is written here? This is only your called accounting policy. By taking all these 5 recipes, you are creating something that is called accounting policy, applied by entity in preparing and presenting financial statement. So principle, you are taking certain principle, you are taking certain base, you are taking certain conventions, you are taking certain rules, you are taking, and certain practices you are taking. These 5 things you are taking and you are following consistently, and that is nothing but your accounting policy. That's why you are telling you maintain or apply it consistently. A change in accounting estimate is an adjustment of the carrying amount of the asset or liability, or the amount of the periodic consumption of the asset. So change in accounting estimate, just a while back I had given one example. Let us take one more example. Provision for doubtful debt. It is a mere estimation. You don't know whether he will pay you back or not. So as per your accounting policy, just like some companies have a policy, if debtor is outstanding more than 6 months, we'll provide in our books of account. If that will come back to the company, then I will reverse that one. Or else if it is a certain period beyond, then I have to go for a write off that amount. So today I am selling, I may wait for maximum 6 months. If within 6 months that realization from customer will come, then it is good. Or else if it is beyond 6 months, then I have to first provide that provision. And if beyond certain period is there, I have to go for a write off of that trade receivable. So this is your policy. So, but this provision that you are making, whether it is 100%, you can say that it will not come. No, it is your mere judgment or estimation. So if tomorrow I have made one provision for one customer and tomorrow he will pay you back, what I will do? I will reverse that provision. So that is what it is telling. It is a estimation. So a change in accounting estimate means, suppose that change I have done, useful life of asset, I have taken 10-year useful life of asset. But literally next year when I went, I see some technical changes are there in market. Maximum I can use that asset for next 5 years. So now that useful life of earlier 10 years has now come down to 5 years. So that is your change in estimate only. So how to deal in accounting if you are making such type of change in estimate? So a change in accounting estimate is an adjustment of the carrying amount of the asset liability. Means your asset is there, liability is there. Your liability for provision is a liability. So there you will change. Asset is there means your carrying amount of the asset will change, or the amount of the periodic consumption of the asset means depreciation may also get changed. That results from the assessment of the present status. Based on the present status, you have done something that will overrule your earlier assumption. Earlier you had some other assumptions. Now going forward, some latest information has come or new developments have come that made you make more realistic estimate. That's why you are changing the earlier estimate. That is called change in accounting estimate. So further it tells change in accounting estimate results from new information or new development. Today after 1 year I come to know that no, was this asset earlier what I was estimating of 10 years of useful life now has come down for 5 years. So I cannot use more than 5 years. So my earlier useful life of 10 years has now come down to 5 years. So earlier 100 rupees asset, every year 10 rupees depreciation was there. Now I have to charge 20 rupees for next 5 years, so that 100 rupees will be depreciated. So that useful change also, useful life change is also change in estimate. So how it comes? It comes basically based on new information or new developments, and accordingly are not correction for error. So change in estimate is not an correction of error. That is very clear in the standard. Then comes prior period errors, are omissions from and misstatement. Either it is a omission, you forgot to do something, or misstatement, the entity's financial statement for one or more prior periods. What happened? I'll give one practical example. Suppose current year in Q1 you have made one mistake. 31st March you found out that one. That is not a prior period error. That is during this error was there, I have rectified this year. Suppose next year also you have made that error. That also you can do in a comparative finance statement. But in subsequent to previous year, last 4 years also you have made the mistake. That is called prior periods. So how to dealt, this standard guides you how to do. So one or more prior periods means one previous year or previous to previous year also you made the mistakes. So that is what it is telling, omission from and misstatement in the entity's finance statement for one or more prior period arising from a failure to use or misuse of a reliable information. Means you didn't exercise your judgment and you made a mistake. So that you have to rectify in your books. So how to rectify the errors? Because we have talked about now accounting policy, change in accounting policy. If change is there, how to do in accounting? Your accounting estimate. If change in accounting estimate, how to dealt in the accounting? Prior period errors. If it is error is there, how to dealt in the accounting. So these things we have to understand in the Ind-AS 8. Information that was available when the finance statement for those periods were approved. Means when you have drawn out financial statement of those years, though that information was there, but you didn't exercise your judgment or your prudence and you missed to do that one, or you omission was there. So you misstatement is there or omission is there, or could reasonably be expected to have been obtained and taken into account. You could have, if you would have tried to dig out, then that information you could have explored, but knowingly or unknowingly you forgot to do that one. So that way it has. So certain examples are like mathematical mistake. In place of 5,000, you put one entry of 50,000. Mistake in applying accounting policy. Accounting policy was something, you made something else. Oversight or misinterpretation of fact. You interpreted something in your way, but later you came to know, no, that was wrong. My interpretation was wrong. And a fraud. Some intentional mistake is also there. So in this standard, fraud is also covered. Fraud is deliberated, but omission is unintentional. So intentional, two type of errors are there. So that also you have to do. So now question comes, retrospective application and retrospective restatement. These two jargons you keep in your mind. What is retrospective application and what is retrospective restatement? So retrospective application is applying a new accounting policy. Means retrospective application means I am going to apply that today or tomorrow onwards of new accounting policy. If any new accounting policies has come to the transaction or other event and condition as if the policy has already been applied. So basically that is called retrospective application, means I will start applying from today or tomorrow onwards. But retrospective restatement is a correction or to recognition and measurement and disclosure of the amount of element of finance statement as if a prior period error has never been occurred. Means suppose I have made an error in the prior period, then I have to go for a retrospective restatement so that those errors of those years I will rectify. But retrospective application means from today onwards, I am going to apply some new accounting policy. So this is called retrospective application and retrospective restatement. So further to that, impracticable applying a requirement. Because Ind-AS also very specifically tells that all the applications of standards are not practical for all entity. Wherever impracticability is there, their exclusion is there that no need to do anything. And what is impracticability that we have discussed now is impracticable when the entity cannot apply it after making every reasonable effort to do so. I tried everything. I explored everything. I have hired consultant. I went for peer company review. I talked to auditor. I talked to management, but I am not able to conclude. I cannot compute the impact. So that is practically, that is not possible for the company. So you have to take a stand by after evaluating, after exercising all of my capabilities, I am not able to do. That is called impracticable in applying a requirement. For a particular prior period, it is impractical to apply a change in an accounting policy retrospectively or make a retrospective restatement to correct an error. If I cannot, after putting all sort of effort, I cannot do, that shelter you can take and you can get excuse of that requirement. The effect of the retrospective application or retrospective restatement are not determinable. Means what is impracticable, that is telling. The retrospective application or retrospective restatement requires assumptions about what means. If I would have been done that one also, I have to take certain assumptions. That is not a concrete one. Similarly, the retrospective application or retrospective restatement requires significant estimate. I have to, no way I have to do an estimation only. That is also not 100% correct. And that is also is called impracticable. Provides evidence of the circumstances that existed on the dates as at which those amounts are to be recognized, measured or disclosed would have been available when the finance means. This is the significant information are available that time. Prospective application going forward of a change in accounting policy or a recognition of the effect of change in an accounting estimate. Because when you are making change in accounting estimate, you have to do always prospective. You cannot do for earlier period. Like useful life of asset you are changing, always going forward that impact should come. You will not go in the earlier period and change it. Similarly, one new accounting policy has come. You have to do going forward. You will not go and do earlier period. But certain exclusions are there that I will tell you. Applying the new accounting policy to the transaction, other events and condition occurring after the date at which the policy is changed. Means after policy change, suppose basically what happens whenever a new policy like your Ind-AS 116 has come recently. So all new policy, whatever, because earlier Ind-AS 17 was there that abolished and Ind-AS 116 has introduced by MCA. So every new Ind-AS comes with a transitional policy, means that standard will tell how to do the transition accounting. Like Ind-AS was implemented on a certain date. So earlier we are following AS. So how to come from AS to Ind-AS, that procedure is called as transitional policy. And every standard tells about the transitional policy. If transitional policy is there, you have to do according to that. If there is no transitional policy, then you have to do it prospectively. You cannot go for retrospective. But if you are doing something change in your accounting policy voluntarily to better presentation of financial statement, then you have to go and change it retrospectively as if that policy was effective from the beginning when the policy was implemented in the company. So this is called prospective application, that is called retrospective application. So what we understood, if you are doing any change in estimate, you have to do prospectively, going forward you have to do. If you are going for any error or omission change, you have to do retrospectively. Earlier period you go and change as if that mistake was not made in those years. Accounting policy, two aspects are there. One is your Ind-AS is telling that transition provision is there, you have to do that. If you are doing voluntarily, you have to go and do retrospectively as if that policy was always applicable for that company. So selection and application of accounting policies, when an Ind-AS specifically applies to a transaction or events or condition, the accounting policy or policy applied to that item shall be determined by applying Ind-AS. Suppose useful life of the suppose your accounting for the model of assets, means PPE talks about your cost model or revaluation model, and that there is a specific guidance in the Ind-AS 16. So whatever policy you will take for your asset, you have to follow Ind-AS 16. Suppose intangible asset is Ind-AS 38, you have to do. Your deferred tax, you have to follow Ind-AS 12. So these particular transaction or events are guided by certain Ind-AS are there. So specifically your policy should be driven in line with the Ind-AS. But in the absence of Ind-AS, certain transactions you are doing, there is no specific guidance or pronouncement in the Ind-AS. How to do that one? In the absence of an Ind-AS that specifically applies to the transaction, other event and condition, management shall use its judgment in developing and applying the accounting policy. If there is no direct linkage to Ind-AS, management has to use its judgment in developing and applying that accounting policy. So relevant to the economic decision making needs of the user, means depending on the economic decision of your industry, reliable in the financial statement, it should be reliable and represent faithfully the financial position or financial performance and cash flow of the entity. Whatever you will do, there is a faithful representation should be there and represent the economic substance of transactions, are neutral, are prudent, are complete in all material aspects. If there is no direct link to Ind-AS, whatever management will do, these 5 points should be duly taken care. Otherwise, it is not a right adoption of policy. So for your information, I have taken this accounting policy of IOCL. You see, a while back I told that accounting policies are part of the financial statement. So basically, this is called a note to financial statement and a significant accounting policy. So it is a part of the note to financial statement along with your SOCI, P&L, balance sheet, cash flow. This is also part to note to financial statement because these are all guided by those policies. And this is called as significant accounting policy. If you go to any annual report, you will get the policy of all standards. Once you go through only, you can understand what exactly it is there in the standard, in the policy of those companies. In making the judgment described in paragraph 10, management shall refer to the considered the applicability of the following sources in determining the order. Means if you are applying one standard, first you go and check whether Ind-AS for the particular transaction or event is there, dealing with similar and related issue, apply Ind-AS. If Ind-AS is not there, you go and check the framework, means conceptual framework issued by Institute of Chartered Accountants of India. So the conceptual framework also part of a standard. If it is not, no Ind-AS is there, then you go to those framework and see whether any pronouncement is there or not. If it is there, follow that conceptual framework. In the judgment described in paragraph 10, the management may also first consider the most recent pronouncement of IASB, International Accounting Standard Board, the body which is responsible in formulation and formulation of IFRS. If in IFRS any pronouncement is there which is near or equivalent to your transaction or the event you are taking, copy paste it from IASB or IFRS. If it is under US GAAP also, you can take it. If any other accounting literature it is there also, like peer company practice or anything is there also, you can follow if there is no specific accounting standard is there for the transaction or event. Or other standard setting bodies like US GAAP is there, or other any international financial reporting standard is there. There also you can do, or conceptual framework to develop the accounting standards, other accounting literature and accepted industry practice. Suppose similar transaction, your peer industries are following some set of practice. You can also follow that one and you can put it as a part of the accounting policy also. Similarly, an entity shall select and apply the accounting policy consistently for similar transaction. What is similar transaction? Suppose you are doing accounting policy for PPE. So similar class of asset, similar policy should be there, and whatever you are selecting, you have to apply consistently. Not that this year I will follow cost model, next year I will follow some other model, third year follow something else. Not like that. Whatever policy you are framing, you have to follow it consistently. If not following, it will attract change in accounting policy. And unless an Indian accounting specifically requires or permits categorization of item, that is nothing but some categorization requirement is there. It means to say that if you go to Ind-AS 16, it tells that if suppose you are doing revaluation for a particular asset, that asset belong to the class of asset, the entire class of asset is required to be revalued. So this is called categorization. Unless an Ind-AS specifically requires or permits categorization of item for which different policy may be appropriate. So you can take a revaluation model for one class of asset, cost model for one class of asset. So that is specifically pronounced by Ind-AS. That's why you can do that one. So that is called categorization. If an Ind-AS requires or permits such categorization, an appropriate accounting policy shall be selected and applied consistently for each category. If that is the case, this class of asset revaluation model, this class of asset cost model, then that accounting policy should be framed accordingly for that category. This is one example. There may be some other example also. An entity shall change an accounting policy only if it is required by Ind-AS. Earlier Ind-AS 17 is there, now Ind-AS 116 has come. So it requires to change the accounting policy, then only you can change the accounting policy. Or the financial statement providing reliable and more relevant information about the effects of the transaction, means it is called voluntary adoption. Means you are doing something policy, you are utilizing something, but now you came to know that no, if I would have been done like that, then my financial statement presentation will be more reliable. So what you are doing, it is not a pronouncement of any Ind-AS. Rather, the company or the management is thinking to do it voluntarily. They are assuming, no, this is wrong. We will go and change the policy. So that is also one of the case. So users of the financial statement need to be able to compare the financial. This is the main objective, that wherever policy should be consistently followed so that comparability of the financial position, financial performance and cash flow can be done unless a change in accounting policy meets one of the criteria paragraph 14. The following are not change in accounting policy. The application of the accounting policy for transaction differ in substance. You are doing something like that only, but now you are telling, no, I suppose let us say one example. Suppose one PP was there and it was running on revaluation model, but that PP now you are taking to asset held for sale, Ind-AS 105. Investment property, Ind-AS 40, because now you are trying to keep it for capital appreciation or rental income and you will dispose it. So that case, Ind-AS 40 only talks about cost model, but earlier you were using revaluation model. So differ in substance means earlier I was taking under active use and PP, that's why that revaluation model was there. But when I brought it to the purview of Ind-AS 40, we specifically talks about cost model only. You cannot do revaluation. So that is not called, this is a substance change, but it will not tantamount to change in accounting policy. The application of a new accounting policy for transaction, other event condition that did not occur previously or immaterial. This is also one case where you cannot say that it is a change in accounting policy. The initial application of policy to revalue asset in accordance with Ind-AS 16. This is the case what I have told. This is not in change in accounting policy. Subject to paragraph 23, an entity shall account for change in accounting policy resulting from initial application of Ind-AS in accordance with specific transitional provision. I told you, suppose any Ind-AS is introduced, it has specific transitional provision, you have to do like that, or else you have to do it retrospectively as if the policy was there from the beginning of the financial year. When an entity change an accounting policy upon initial application of Ind-AS that does not include specific transition accounting policy, that is called voluntarily, means there is no Ind-AS came, but you are doing, it shall apply change retrospectively. When you are doing voluntarily any accounting policy change, you have to go back from the beginning and you have to do retrospectively as if it was always applicable to the company. Similarly, retrospective application, the entity shall adjust the opening balance of each affected component of equity for the earliest period presented, and new accounting policy had always been applied. What I told, suppose any change in accounting policy is there, go and from the year beginning where this accounting policy was applied, go and that impact you bring and put it in the third year balance sheet as per the Ind-AS 1 it is there, and you have to give the impact, anything is there in the return earning of that third year balance sheet, and you have to regularize that in. So this is also called as a retrospective application. Limitation of retrospective application, a change in accounting policy shall be applied retrospectively except to the extent that it is impracticable. A while back I told, if you want to change the accounting policy and it is not practical to determine the impact from the beginning, that shelter you have to take, but you have to discuss this matter with your auditor and you have to convince them how it is not impracticable. Then only shelter can be given that no need to go and retrospectively change that. This is called limitation on retrospective application, that is impracticability. That standard gives a shelter to the user. When it is impracticable to determine the period specific effect, the entity shall apply the new accounting policy to carrying amount of the asset and liability as at the beginning of the earliest period. The same thing, what I told you. When it is impracticable to determine the cumulative effect at the beginning of the current period or applying the new accounting policy, all the period, the entity shall adjust the comparative information to apply the new accounting policy prospectively from the earliest date applicable. So when it is not impracticable, only you have to do prospectively. You cannot go retrospective. As a result of uncertainty inherent in the business activities, this is called now our accounting policy is over. Now we have to jump to accounting estimate. So what is accounting estimate? Uncertainty inherent in business activities. Many items of financial statement cannot be measured with precision, but can be only be estimated. Estimation involves judgment based on the latest available reliable info. Now I need only 5 minutes to complete my presentation. So earlier I have told what is change in estimate. The standard specifically prescribes bad debt, inventory obsolescence means moving, non-moving, fair value of financial asset, useful life of the asset like your asset and warranty obligation. These are all your estimations. Nobody can go and do that computation or measurement with 100% precision. So you have to only use your judgment and do the estimation. So if any change is there, that is called change in estimate. And change in estimate is always required to be done prospectively, not retrospectively. The effect of change in accounting estimate other than the change to which paragraph 37 applies shall be recognized prospectively by including profit and loss. No need of retrospective. If change in estimate is there, always going forward you have to do, no need to look back. The period of change, if the changes affect the period only, and the period of the change of future period, and you have to give the impact if due to change that estimate, how it has impacted your current financial year and the future financial year. To the extent that the change in an accounting estimate gives rise to changes in asset liabilities related to an item of equity, it shall recognize by adjusting the carrying amount in the period of the change. That you have to do in your financials. Suppose your useful life you have changed. So how the depreciation done and other thing that you have to do. Error, now we will come to error. Error can arise in respect of the recognition, measurement, presentation or disclosure of element of financial statement. And financial statement do not comply with Ind-AS if they contain either material error or immaterial error made intentionally to achieve a particular presentation of entity's financial position, financial performance or cash flow. Potential current period error discovered in the means either error can be detected for current year or you may also detect for earlier years. So error may be detected in 2 periods. So potential current period error discovered in the period are corrected before the financial statement. Means suppose I told Q1 you have made some mistake. Q4 you have discovered that one, go and change that error in that financial year so that it is not a prior period. But if that error is a previous year, you can also go and do the comparative figure change. But if it is more than 1 year, then you have to do a third year balance sheet for that comparative information presented in the financial statement. Subject to paragraph 43, an entity shall correct material prior period error retrospectively. Error can always be done retrospectively, as if that error has never done. In the first set of the financial statement approved in the issue of the discovery. Whenever you are discovering, you have to go and you have to change. Restricting the comparative amount for the prior periods presented in which error occurred. Suppose earlier period error is there, so you have to go and change so that current year and previous year can be comparable. If the error occurred before the earliest period presented, restating the opening balance of the asset liability equity for the earliest period presented. You have to go, you have to change that error so that in the opening third year balance sheet, you have to bring all these changes through return earning, either asset or liability. Wherever impact is there, you have to bring those impact as if that error has never happened in your books. So with this, my deliberation for this Ind-AS 36 and Ind-AS 8 is completed. Because of this restriction of time, most of the cases I have not covered, but hope my deliberations are clear. So now forum is open. If any question answer is there, I am glad to share my view if I can understand your question.
Thank you, sir, for your nice presentation. One question is there in chat box. Sir, please explain how we impairment of goodwill with example.
Look, goodwill today I have not covered. Goodwill is basically, I will give you one example how goodwill is there. Suppose impairment can be done in two ways. One, let us goodwill is there. Suppose the goodwill is an intangible asset. Whether there is indicator is there or not, you have to test check every year. So for that goodwill, whether that goodwill is attributable to one CGU or multiple CGU and how benefits will arise for that goodwill, you have to do a projection and you have to test check that goodwill. But suppose any goodwill and consolidation is there, means suppose you have acquired a subsidiary, their net asset was 100 rupees, but you have paid 150 rupees. So that 150 rupees, what extra you have given, when you will do the consolidation, that will be part of your goodwill on consolidation. So that impairment test is something different. How you will do? First, you have to test check the impairment of your subsidiary PP. Your subsidiary will go and test check the impairment for their PP. If there is any impairment is there, they have to impair their PP and put that impact in your financials book. If it is not there, no need of do anything. But if impairment is there in their book, while doing the consolidation, first you have to do that that whatever impairment they have taken in their book, that you have to reverse. Suppose they have taken an impairment of 50 rupees, but your goodwill is 30 rupees. So while doing the goodwill on consolidation, that 30 rupees first you have to exhaust your goodwill on consolidation. Rest 20 rupees in your console financials, you have to hit your PP. So this way you have to impair your goodwill on consolidation and means consolidated goodwill and purchase goodwill. This two way you can do impairment testing.
Thank you, sir. Now we are not able to take much question. All are requested to drop your question in our mail cbc@icmai.in. We will send your question to our resource person and the reply will be shared. Now I request our secretary, CMS Sujanaran Tripathi sir, to kindly give the formal vote of thanks.
Thank you, Himal sir. Very good evening to all. Honorable today chief guest CMA H. Padmanabhan sir and special guest CMA Niranjan Mishra sir, respected chairman of the chapter CMA Himoj Mishra sir, chairman PD committee and past chairman of the chapter CMA Sakhdar Singh sir, our most valued invited guest, CMA members, students. It is my privilege to have been asked to propose a formal vote of thanks on this occasion. I, on behalf of CMA family members of Bhubaneswar chapter and on my own behalf, extend a very hearty vote of thanks and deep sense of appreciation and gratitude to CMA H. Padmanabhan sir for accepting our invitations, gracing and addressing on today's program on virtual platform. It is pertinent to say that your kind presence is inspired to us, sir. Thanks to CMA Niranjan Mishra sir, who is our mentor and guide. We convey thanks and gratitude from core of my heart for your continued support to the chapter. Thank you, sir. Now come to the resource person, CMA Ramshankar Mishra sir, who is a young, dynamic and alumni of the chapter. We are so pleased and impressed on your today's deliberation. Ind-AS 8 accounting policies, changes in accounting estimate and errors, and Ind-AS 36 impairment of assets. We pray before Lord Jagannath for all prosperity of yours. We happy to listen from a product and member of WEBINT chapter of our chapter. Thank you, sir, once again. Dear professional friends, we have been fortunate enough to be backed by a team of very motivated and dedicated colleagues of WEBINT chapter who know their job and are result oriented. Thank you all for supporting. Thank you all the supporting staff and MC member for their support for organizing this webinar. Last but not the least, I convey bottomless appreciation to the participants for their massive and continual support to make this event grand success again. We hope same sort of support coming in next 2 days webinar held on 24/3/2022 and 25th March at 6:30 p.m. and all other future events. Thank you for your cordial cooperation. Thank you, sir. Sir, namaskar. Jai Jagannath.
Thank you all.